Hello everyone, welcome to Oliveboard. A warm welcome to you all in the session of Oliveboard in the YouTube channel of Oliveboard. So I hope I'm audible, the slide is clear, everything is fine. So let's start the session. Let's start quickly the final marathon of two modules again, module C and module B. Yesterday we completed module A and B. Those who have not watched that module, so kindly watch. Okay, if you will watch at 1.5x, then still you will going to understand. So let's quickly start with our module C and D. So first we'll complete module C and then module D. Now, so what is the first topic of module C is the corporate valuation. The corporate valuation is wherever you are purchasing any company. Okay, you are the buyer, the another one is seller. Now you are purchasing the company of this person, Mr. Y. So what you will do first, you will find the correct valuation of that company. So valuation means finding the value of a company to know what is the worth of that whole business is. So we need to do corporate valuation with the why do we need for buying and selling, for doing mergers and acquisition, if you are issuing any kind of shares, if you are raising fund from investors, okay, for legal purpose. So this is the reason why you want to do the valuation of these companies. So different companies, different sort of valuation we will use. So corporate valuation is a process of determining the value of company entity. Now, two types of value is done. First is book value, the value which is written in your books of account, that is in your balance sheet. And the market value means what? What is the value of your shares in the market? That is the market value. Now, this is important. So the International Asset Valuation Standard Committee is responsible for adopting what? For developing this international valuation standard. So IBPS is developed by whom? International Asset Valuation Standard Committee. Now, this is the difference between book value and market value. So, book value, what the value that contains in your books of account, book value, and what is the value of the your shares in the market, the current price in the market is market value. Accounting based on cost depreciation, buyers and sellers, it changes slowly and it changes daily. So, what is the how to calculate book value? Total assets minus total liabilities divided by number of shares and the current share price into number of shares. So, number of shares into market price MPS. That is the value of market value. Now, for this we have various approaches, starting from income to direct comparison approach. Now, income approach, what it tells you that how much income you will going to make from this company in future. What is your future earnings? Tell me that. Then only I'll purchase your company. So income approach is what? It is future profit method. What? It means how much money it will going to make in the future. Like you are having this company, okay, XYZ. Now, if I will purchase this company, so what benefit I will be getting? What is the future earning of this company? So, but future money is discounted in today's value. So, what you will do? You will find the present value of all your future cash flow of this company. So, how to do? How to find the discounted value? That is, you have to do discounting. Clear? Now, this is how you will do the discounting every year. If you are getting the cash flows 1 lakh, 1 lakh 20,000, 1 lakh 50,000, 2 lakh, and the discounting rate is given 10%, adjusted discount rate. So, how to calculate the discounting rate? I have told you several times. So, 1 upon 1 plus 10%. Now, so 1 upon 1.10, if you will do equal to, you will be getting 0.9. In that 0.909, if you will 1 divided by 1.10, 0.909, if you will do equal to, you will be getting 0.826. Again, if you will do equal to 0.751, again equal to 683, again equal to 0.620. So if you will multiply this with 0.909, 0.826, then multiply 0.751 into 0.683 into 0.620. So you will be getting the net present value of the company. That is how you will do the discount. Clear? Now, then market-based approach is what is the value of your assets okay, of your company and what is the value of another company. So if I am not able to find the value of your company, so what I will do, I will find the similar type of company, okay, just working like you. And what is the value of that company? The value of that company I will put into your company. So this is how to find the value of a business by comparing it with similar companies in the market. Clear? Like the value of that company is worth rupees 10 lakh. Now, so this value I will going to take your company. So what I will do in that case, I will find the multipliers of the comparable companies. With the help of multipliers, I will going to find your company. Like multiplier will come 10 times. So I will ask that what is the EBITDA of your company? Then suppose you have said my EBITDA is 20 crore. So I will multiply 20 crore into 10 times. So I will take the value 200 crore from your company. So similar business are listed or sold recently for stock market valuation. The cost-based approach, what it will talk about your what is the value of your assets, the fair market value of assets. The fair market value of assets, what it would cost to build the business today. Like machines, you are having 20 lakh. The market value of this machine, the asset is what 20 lakh. Then building 30 lakh, land 50 lakh. So total value is what 1 crore. So this is the value of your assets. That is cost based approach. Then adjusted book value approach. See, book value is approach which the balance sheet contains. Now, adjusted book value is what? It will adjust some elements into your book value, that is adjusted book value. So, in adjusted book value, we will deduct current liabilities. Okay, we will not going to take current liabilities. From your total assets, you will be deducting current liabilities. You will be taking long-term liabilities, but not your current liabilities. So, balance sheet value plus adjustment for real market value, that is adjusted book value approach. Clear? In this book value approach, you will calculate with the help of two sides. One is from liability side and one is from asset side. Okay? The shareholders valuation. Now, next is that is the stock and debt approach. Now, stock and debt approach, what it will tell? It will basically tell you that the debt which you have taken loan from the company and stock means what? These are the assets. Now, how you will do the value in this case? All your current liabilities will be deducted from your value of assets. Like value of your assets are given 1 crore, debts are given 30 lakh. So debts are what? These are the part of current, these are the part of long-term liabilities, the debt which you are taking loan. So net asset value, how you will going to find NAV, that is value of assets minus the all your current liabilities. Now, direct comparison approach, again, direct comparison is a type of market approach where you will take the multipliers of the comparable company and you will do the valuation of the company which you want to purchase. So it directly compares with recent sales of similar business or assets. That is direct comparison. You are directly comparing your company with another company. You are finding the similar type of company and you are finding the value of that similar company and you are using that value into your company which you want to purchase. Like let's take an example. Okay, you have a limited company. Now, this is you. If you want to purchase B limited company, but you are unable to find the valuation of this B limited. So what you will do, you will be finding similar type of companies just like B. You will find the value of these companies. Whatever value of these companies will be there, you will put the value of that B limited company. So this is all about the summary table of your income approach, market approach, cost approach, adjusted book value, profitable, running business. It is used for market approach. What is the value of your shares in the market approach, recent business sales, cost approach, heavy asset business liquidation, adjusted book value, you will adjust some value from the book value, stock and debt approach, simply assets minus liabilities, and direct comparison, comparing similar type of businesses. Again, now next we have what? See, in these are the approaches for valuation. In direct comparison approach, what you will do? I have told you, you have to find the multiples. Now, how to find these multiples? These multiples will be found with the help of all these multiples. Like some companies, they will take the earning for finding the for using the value. Some will take the book value, some will take the sales value, some will take the your EBITDA, some will take the only operating profit. So these are the common multiples in direct comparison method. So PE ratio, what is PE? Price to earning ratio. It means your market price per share upon EPS. Okay, what is the value of your per share in the market? That is price to earning ratio. Now, price to book ratio, what is the value in your book? Okay, market price per share upon BPS, that is book value. Price to sales, market value upon sales per unit. EBITDA, enterprise value, EV upon EBITDA. EV means enterprise value upon EBITDA. So, industry standard for valuing the entire business. This is EV upon EBIT. So, EBITDA is what? Earnings before interest, tax, depreciation, and amortization. So remember, for your tangible assets, you do depreciation, and for intangible assets, you do amortization. Here, the EV upon sales, price to cash flow, that is market capitalization upon operating cash flow. So these are the multiples in direct comparison method, and all are important. Clear? Like if any company A, okay, company A, MPS is given, company B, EPS is given. Now, what you will find the value of MPS upon EPS. Suppose let's take an example. MPS is given 1000. Okay, EPS is given rupees 100. So it means what? Wait, let me turn off. It means what? The multiple of this company is company A is 10 times. Now you will use this multiple in the company, that company which you want to purchase. Now, what are the steps involved in valuation of DCF approach? Now, in DCF approach, that is discounted cash flow approach. So discounting, we have to do what? It considers time value of money. This is just we have studied. This is discounted cash flow approach. So following steps are involved in the process of evaluating a company using the discounted cash flow approach. First, you have to analyze all your historical performance to calculate. Okay, we will be seeing how to use these performance operating OIC, NOP, LAT, return ROIC, and net investment. Okay, we will be seeing. Now, next is what? Calculate free cash flow. So, free cash flow is what? The amount which is left over. Amount which is left over. Left over means after paying all your liabilities, all your debt, whatever amount is left over in the company, that is called calculate free cash flow. So, how you will calculate free cash flow? With the help of analyzing these historical performance, operating invested capital, net operating profit, NAT. Now, let's understand what are these. See, operating invested capital is what? OIC. Now, operating means what? The day-to-day transactions, day-to-day activities which you are doing in your company. That is what's operating. Now, in that transaction, what money you are making, okay, how much money you are making from your core operation of the business, excluding your cash and financial assets. So it shows how much money is tied up in the core operation. So how to calculate operating invested capital? All the formulas are very, very important. So what? Total operating assets minus operating liabilities. Those assets which are used in regular purpose like working capital, okay, all those. So total operating assets minus operating liabilities. And one more formula is what? Net fixed asset plus working capital. So operating assets, what? Like your machinery, your stock, okay, your VR. So these are what? Your operating assets. Now operating liabilities are what? Your BP. So your creditors. So these are your operating liabilities. So these two are the formulas for calculating operating invested capital. Now, next we have, see, this is one operating invested capital. Now, next is NOP LAT. Now, NOP LAT is what? Net operating profit less adjusted tax. You are finding the operating profit, and in that profit, the tax is not included. Tax is what? deducted. Let's adjust it tax. Now, so real operating tax profit after tax. After tax, whatever the profit is left, that is called your net operating profit less adjusted tax. Operating profit remains after paying tax. So this is the formula. Operating profit is what your EBIT into 1 minus tax rate. Suppose EBIT is given to you, like let's take an example 20 lakh and tax is given to you 30%. So we can write 1 minus 0.03, 20 lakh into, so this will become your NOPLA. Now, next is ROIC. So, this is what returns you are making, okay? What profit you are generating from from invested capital. So, shows how efficiently the company is using its operating capital. So, NOPLAT upon operating invested, the one which we have studied, OIC into 100. This is your return on invested capital. So, this is all your in a short. Now, after this, what you will do? Yes. After this, you will calculate the free cash flow. Okay. Free cash flow means amount which is left over after paying all your debts and all your liabilities. Now, next, to calculate weighted average cost of capital. What is weighted average cost of capital? It is overall cost of capital. Now, what is WACC? Okay, I have added in that slide. Now, after calculating your weighted average cost of capital, see, first you have to calculate your free cash flow after analyzing all these historical performance of your company. After that, you will calculate your weighted average cost of capital. It is overall cost of capital, okay? KD into RE, KP into RE. This is a WACC. Now, based on the calculation of free cash flow, that is in step 2, now you will forecast your future cash flows for an explicit period using what? WACC. Means now you will be finding your present value. After this, after present value, find the terminal value after the explicit forecast. Now, what is the terminal value after the explicit forecast? Means those assets which you don't want to keep in your company. Why? Because either they have become obsolete or they have become outdated. So what value you are getting? The salvage value after removing all these assets, what the salvage value you are getting? That is what the terminal value means, the final value. Okay, and then you have to find its present value. Now, what are the values you are getting in step 4 and step 5? You have to add all these values, the value of non-operating assets to find the valuation of the firm. This is using the discounted cash flow. So first, you have to find all the present. You have to find the present value of all your future cash flows. Okay, after analyzing all these historical performance. So these are all the steps and the this A, B, C, D is this one. A, B, C, and net investment. And this is the crux of all the factors. Now, next we have what? Net investment. This net investment is what? How much new money the company has put into its business operation. See, if you are running a business, definitely you will invest into your business. Now, while investing in the business, for what you will do? You will do the forecasting, you will make assumptions, okay, you will test the market, you will make the analysis. After doing all this, whatever returns you are getting, what you will do in your next investment, you will put that money into your core business operation. Okay, how much new money the company has put. New money means what? The new money, their capital, or they have invested the returns has put into the business operation. So net investment is what? Operating invested capital, that is OIC of your current year and of your previous year. So the value of your current year and your previous year, difference between these two is net investment. Or if in the question the capital expenditure is given to you, capital expenditure means what? Like if you are purchasing any new machinery. or if you are repairing any new machinery, or if you are doing any kind of deferred expenses in that, all will come under capital expenditure. Or you are making, you are doing the, you can say, incurring expenses in advertisement. All this will come under capital expenditure. Plus increase in working capital and depreciation, that is reduction in the value of old assets. So this is for tangible assets, and for intangible assets, I have told you amortization. Now, so suppose this is the question given. Okay, net fixed assets are given, working capital, earning before interest and tax rate given 30%. So 30% we can write as 0.30. Now, how to calculate operating invested capital? Now, what was the formula? Just now we have done operating invested capital. That is operating assets minus operating liabilities. But if you will see over here, you have got net fixed asset and working capital. So one more formula, we were having the net fixed assets plus working capital. So what is 15 lakh plus 5 lakh is equal to 20 lakh. Now, NOP LAT, what is the formula of NOP LAT? That is your EBIT into 1 minus tax rate. So what is EBIT? EBIT is 4 lakh into 1 minus 0.30. If you will calculate this, 4 lakh into 0.7. What is the answer? We calculate 4 lakh to 0.7. It is 2,80,000. Now, what is ROIC? Formula of ROIC? NOP LAT divided by operating invested capital. NOP LAT is how much? Just now we have calculated 2,80,000 divided OIC. OIC is what? 20,000 into 100. So that is your %. Understood all the questions? Clear? Now, next we have completed our unit 13, that is corporate valuation. Now, unit 14 is all about your discounted cash flow valuation. Discounted cash flow valuation means you have to do the discounting of your all cash flows, and then you will do the valuation of that company. Now, in discounted cash flow, we have different inputs are given. Now, what are these inputs? That is, they will help you to, these inputs are, you can say, the stages, or you can say the steps. Now, so first is that is predicting cash flows in the future. Okay, predicting cash flow in the future, finding that what this company will bring the cash in the future, what is the future earnings of this company, predicting the cash flows in the future. Then the discount rate, that whatever the discount rate is given, that discount rate is suitable for that risk. If risk is high, and if risk is high, the risk premium is provided. How you will do the discounting at that time when the risk level of risk is high. Then estimated cash flow growth rate, that is what is the growth of the company. Is the growth rate high or the growth rate is low? And estimated pattern of growth. Estimated growth patterns is what is the growth pattern of the business. What is the growth pattern of business? Okay. Is the company is having the constant growth? Constant growth means that is stable. Stable means it is growing in a linear way. Or the company is having sometimes the growth is very high, sometimes low, then high, then stable, then low, then high, then low, then stable. Or it is having only high growth. or having only low growth. Okay, going down. So this is the estimated pattern of growth rate. Now, so for this, we have approaches to discounted cash flow models. Now, we have three approaches. These we have for these three approaches. Now, in these three approaches, the first approach is very, very important. This is very, very important. Now, what first approach will tell you? First approach, it is based on your cash flows. It is based on your earnings. It is based on your cash flow. Now, second approach, it is based on the earnings. Okay, the present earnings of the company. And the third approach is what it is based on the growth of economy. And among these three approaches, the first approach is very, very important. Now, what is the first approach? First approach is what it will ask that suppose I am the purchaser and you are the buyer. Okay, now I will ask from you that if I'm purchasing your company, is it possible to estimate the cash flows of your company? Is it possible to estimate? Now, if the buyer will say that yes, it is possible to estimate the cash flow of the company, then I will ask another question that what is the type of leverage? Means what is the risk in your company? You are having business risk, financial risk, or both risk. So what is the type of leverage? What is the risk? Now, the buyer will say that risk in my company is static. Means if there are chances that there might be the drop of sales of 10%, okay, so this 10% is stable. Means the risk is what? It is static, it is stable. In that case, what type of cash flow I will use? I will use that cash flow which is available to your equity shareholder. So free cash flow to equity. Okay, the cash which is available to equity shareholders. Now, if the question is no, if I ask that it is estimate, is it possible to estimate your cash flow? If the question is no, then I will use in that case the simply dividend discount model. Dividend discount model means what? The growth model. Clear? So D1 upon K minus D. So this is what the dividend growth model. Now, if in type of leverage, if the answer is dynamic, that is the risk, sometimes the risk will go 10%. Okay, then there are chances that it will be as the loss will be of 12%, the loss will be of 14% in next year. Then I will, in that case, what cash flow I will use? I will use that cash flow which is available to the firm, the firm's cash flow. So this is the first approach that is very, very important. Clear? The first approach. Now, next approach is what? Next approach is based on your earnings. This approach was based on your cash flow. Next approach is based on your earnings. Now, second approach, if I will choose second approach, I will ask that what is your current earnings? Is your current positive and normal? Then I will use the current earning base. Okay, the current year, the current rate I will take. Now, if answer is abnormal or negative, then I will ask again from the buyer that do you have any current earnings in your company right now? If you will say yes, then I will use the normalized earning. Normalized means some correction factors are given to you. Okay. Now, with the help of that correction factor, I will normalize all your cash flows. Now, if current earning is not present, then again I will ask the next question that survival is possible or not. If I will buy your company, I will survive with your company or not. If survival is possible, yes, then we will use margin adjustment needed. If no, then again I will ask that do you have the risk in your firm? Is your firm overburdened with debt? You are having more and more loan in your company? If the answer is yes, then I will take the value as an option to liquidate. Means the liquidation value which is available to equity shareholders, I'm going to take that amount. Okay, the residual value of the equity. Now, next, if the burden is, if there is no any kind of burden, means no debt is there, then I will take the liquidation value of the company, that is first. This is second approach. Yes. Now, next approach is what if I will ask that what is the present growth rate of your company, you will say that it is less than the economic growth rate. Means economic growth rate is high. It is less than the economic growth rate, then use stable discount model. If it is more than the economic growth rate, then I will ask that do your firm is having the competitive advantage? How you are differentiating your product with the competitor's product? Competitive advantage is what differences you have in your product and the competitor's product. That is what the competitive advantage. Clear? So is your is competitive advantage is there? If it is yes, then use two-stage model. If it is no, use three-stage model in that case. Now, so various discounted cash flows model are there. Now, various discounted cash flow. See, this all three approaches are related to approaches to discounted cash flow model. This DCF. Okay, three approaches. Now, this one is discounted, various discounted cash flow models. Now, types of discounted cash flow model is there. The first is enterprise DCF model. Now, enterprise DCF model, what it says that it basically asks your FCFF, free cash flow to firm, enterprise discount model. Model applies a discount rate equal to the weighted average cost of capital. So here debt will be included, overall cost of capital will be included, and WACC will be included. Clear? Now in equity DCF model, the equity discount cash flow will be used. Only equity will be used. That is free cash flow to equity. FCFE will be used. In that case, that is cost discounting factor. What I will use in that case, the KU. Clear? In FCFF, which profit NOP LAT, that is after paying tax, after paying all the taxes, what profit you are left, profit that profit we will going to consider in this case, the total cost of capital. Now, in equity DCF model, the dividend discount model is used with the help of dividend discount model and the free cash flow to equity model, that is FCFE. Then dividend discount model takes into the account of cost of equity, and free cash flow, it will take into account again the cost of equity, because these two are the sub part of equity discount model. Then adjusted present value. Adjusted present value is what it takes into what probability. That the present value, it needs to be adjusted. Okay, the factors are given to you, the probability factors are given to you. Suppose, let's take an example. Okay, I'm taking over here. Let's take an example that in first year, second year, third year, you are getting cash flow 10,000. In second year, 20,000. In third year, 30,000. Now, what are the probabilities that in first year you will get 10,000 rupees? The probability is, let's take an example, 80%. So it means in that case, what present value you will consider? You will consider only 8,000, because the probabilities are only 8%, 80%. In this, the probability is 100%. You will take 20,000. Now, here the probability is only 15%. So you will consider your 15,000 as your net present, as your present value. So this is adjusted present value. Now, WACC is what? Again, WACC is average rate of return a company uses to pay its debt and equity investors. And this average rate of return is what? It is minimum required rate of return. A minimum return that a company must earn on its investment. Why this WACC is important? It is used in DCF also. It helps you to decide. It helps you to make a decision that if you are getting the returns higher. Okay, return is, let's take an example, 10%, and your WACC is what? The WACC is 8%. So you will going to accept that project. You will going to invest in that project. That is good investment for you. If your returns are less than WACC, means it is a bad decision. You will not going to accept that project. Now, how to calculate WACC in this case? Weighted average cost of capital. Now, following details are given. See, equity capital market value is given. If market value is given, you have to change them into weights. Okay, how to change them into weights? See, the total capital is what? Equity plus debt is how much? That is 10 lakh rupees. Now, 8 lakh upon 10 lakh, what it would be? 0.8. It would be 0.2. Now, cost of equity given, cost of debt given, and corporate tax, that is 0.30, 0.12, 0.10. This is what? This is the formula. WE into K, that is the weight of, what is the weight of equity was? That is 0.8. So 0.8 into 12%. Again 0.2 into 10%, and tax was given 0.3. Clear? So 0.1 minus 0.3. Now, if we will calculate 0.8 into 12, 9.6 plus 1.4, that is 11%. It means your WACC is 11%. Okay, if your WACC is 11%, then the returns should be more than that. Then only you will accept that project. Otherwise, not. Okay, now next is that is dividend discount model. So again, dividend discount model, what is this model is? It determines the value of company stock based on its all the present value of your future dividends. Means what dividend you are getting in future, it helps to find the present value of your future dividend. So what is the formula? It is known as Gordon growth model. D1 upon R minus D. This R will be sometimes written as cost of equity, because see, discounting is done with different methods, with APT also, with WACC also, with dividend discount model also. Now, in this case, P is equal to D1 upon R minus D. What is P given? Current stock price given, the value of stock. What is the value of stock today? Dividend in the next period, that is yet to receive D1, and sometimes DO is given, that is old year's dividend. R is required rate of return, and G is what? Growth rate of dividend. So G is growth and R is required rate of return. Now, this is the question. Then constant growth model. So there is constant growth model, there is zero growth model. In zero growth model, what is the difference upon D1 upon G? That is the zero growth model. Okay, sorry, R, D1 upon. Now, in constant growth model, this is the question. XYZ Limited is expected to pay a dividend of 3 per share 1 year from now. It means the D1 is given to you rupees 3. Now, dividends are payment expected to grow. G is given what? 5%. We can write 5% as 0.0. And investor needs 12% required rate of return. Now, R is given what? That is 12%. So again, we can write 0.1. Now, simply D1 upon R minus D. What is D1? 3 upon 0.12 minus 0.05. If you will calculate 3 upon 0.12 minus 0.0, that is 3 upon 0.07 is equal to 3. That is fair price of the share will be 42.86. Clear? Okay. Chal. Now, so this is the question when your dividend was given. Now, when in the question, if previous year dividend was given, okay, previous year, that is DO was given, Now, how to find D1 in that case? Simply what you have to do, DO 1 plus, and what is that? The growth rate. So this is the formula for your dividend, current year dividend, or dividend yet to receive. That is DO into 1 plus T. Clear? Now, next we have two-stage model. So two-stage dividend model assumes that dividend will grow at a different rate during two. Now, two-stage model, again, it is divided in two stages. First stage, what it will tell that the growth is very high. Okay. First, the two-stage model will tell that the growth is high, then growth will become what? Stable. Stable means the constant. If the growth is increasing 10%, okay, then 12%, then 13%, and then it is stable. It is now stable at 13.5%. This is the constant rate for it. So this is two-stage model. This is the formula and calculated using Gordon growth model. Now, next is three-stage model. So again, in three-stage model, three stages are there. First, the company will grow at high growth phase. Okay. Then the growth will be comparatively slow, growing at the rate of 10%. Okay. Then 12%. Then growing what? 13%. Then growth will be less, 13.2, 13.3. Okay. Growth starts to slow down. And then it will what a stable growth will be there. That is the same this 13.5, 13.5, 13.5. So high growth stage, the three-stage model is used to find the value of a company by predicting its future growth. It is used when company growth rate changes over time. Now, three-stage model and H model, they are likely to be same, but there are differences. So we will going to see that. Now, in stage first, high growth phases, their company will grow very fast in the beginning, just like new technology, new startup companies. Then transition phase, the growth will be slow. Then growth will start to slow down. And stable growth means then growth will become the steady and stable. Means if it is growing at 10%, okay, let's take an example 2%, 4%, okay, 5%, 7%, then growth will 7.8%, then 9%, 10%. Now growth is only 1%. Okay, then it will become what? Stable. At 10.5, now it will become stable. This is stable growth rate. Now, H model is what? Again, it is the model which helps to calculate the value of your firm. So we can say valuation model. Now, what it does? H model started very you can say it starts very high. The high growth is very high. Then it becomes what? The growth is decreasing, and finally it becomes what? Stable. The growth is high, then decreasing, and then becoming stable. This is H model. It also tells you the two in two stages. Now, who developed this? Fuller and Sear developed this model. Stage one talks about that growth start at high stage. Now, high is denoted by GA. Remember, high is denoted by GA. The growth is very high, then it decreases gradually, but at a linear decrement scale. Decreases slowly over time. In stage two, growth becomes stable and this constant growth is forever. So first it grows at a very high rate, then the decrement is what? The decrement becomes linear and then stable. Now, what is H in this H model? H is what? Like if the growth phase, if I say that the company will grow for, let's take an example, for 12 years. 12 years, the company will grow. It means what? The H is what? That is 5 years. So H is 12 upon 2. Okay. H denoted what? The half of the year. So if it is 12 years, then 6 years. H will be 6 years. If it is 18 years, H will be 9 years. So earnings growth rate decreases linearly from GA to GN. GA is increasing growth, GN is decreasing growth. And it is what? It decreases linearly. Linearly means in a one, you can say one parallel line and at the same cost. Dividend payout remains constant over here. Cost of equity also remains constant. And after stability, GN continues forever. So just growth is represented by GN and the decline is represented by GN. So two-stage and three-stage model, this is the difference. Constant growth is there. Here grows very fast, then gradually declining, and then linear declining is there. High growth for few years. Here is growth is starts it very high, then declines gradually, and then its stable growth means the linear growth. Okay, it is less realistic, it is more realistic. So this is the formula for H model. PU stands for what? PU is what? That is the stock price of shares in the market. That is the stock price. DO represents what? That is the dividend which you have received in the present year. Dividend received in the present year. Now, 1 plus GN is what? GN is the growth rate, the company high growth rate. GN, uh, GN is what? The, you can say this, the declining rate. GA is the high growth rate. R is what? Rate of dividend, required rate of dividend. And GN is what? That is the declining or maturing phase. And H represent for that is the half life of the growth. So this is all written. Now this is what? This is H model. See, it started, the growth is very high. Okay, it started very growth. Then the gradual decrement is there. And after gradual decrement, what happens? The linear growth, the linear and stable growth is there. So this is what? This is the company will grow, then company will gradually decline. Okay. After gradually decline, they will maintain the stable rate. They will be at a linear decrement. So this is G1, this is G2, or you can say this is GA and this is GM. H model important. Now, next we have unit 15, that other non-DCF fund. Now, here we have seen that how to do the valuation of any firm following discounting methods. Following what? Discounting methods. Now, here we will going to study that how to do the valuation of companies, valuation of firms following non-discounting methods. Now, in this non-discounting, evaluation methods are broadly divided into two groups. One is DCF and the non-DCF. Now, in this chapter, we will be seeing how to do the valuation without doing discounting, without considering time value of money or non-discounted cash flow valuation methods. Now, so these are relative equity, enterprise, book value approach, and again stock and debt approach. Now, how to find the first? We know that if we are doing the valuation of any company, so enterprise valuation is there. Okay, then different companies are using different type of cash flows. EBITDA is there, CFET is there. Okay, PAT is there. Earnings before interest and tax is there. Some will consider the P ratio. Some will consider the book value. Some will consider the book value. So how to figure out the valuation multiples for the comparable companies? Comparable companies means the company, those companies which you are doing the comparison for finding the valuation of your company. Okay, your company means the target company. So what you will do? See, these are the valuation multiples given of two companies, company A and company B. Now, company A, there are two similar businesses, A and B, and their respective financial data. All the data are in crores. Sales are given, company A, company B. EBITDA is given. D stands for depreciation, A stands for amortization. Book value and enterprise value. Now, how to find the valuation multiples for the company? First, company A, if I'm taking the EBITDA, okay, then enterprise value upon EBITDA. So, EV upon. So what is EV? EV is 3000. 3000 upon EBITDA is how much? That is 1000. So that is the value company A will come. How long this live session? We have to complete two modules today. Yesterday we completed module A and B. Today we'll complete C and D. So I guess it will take approx 11 to 11:30. Okay, 4 to 5 hours more. Now, then next company B. Company B is what? Enterprise value is given 4,500 and EBITDA is given 2,000. If you will calculate, you will be getting the multiple 2.25. Now, how to do the average? 3 plus 2.25 divided by 2, the average is there. Simply, in the book value, you will find book value is given 4,000, 6,000. EV is 3,000 upon book value is what? Book value 4,000. If you will divide, you will be getting this value. Again, if you will do the average, that is 0.75 plus 0.75 upon 2, 0.75. And simply you will find the value of sales. So this is how you will find the multiples of the companies. Following EBITDA, following book value, following sales. Now, so we have one question for that. See, the following financial information is available for company M. Company M is an unlisted company which is being valued. Being valued means this M company becomes what? The target company. Now, what is the value of this company is given? The EBITDA of this company is given. EBITDA is given 500 crores. Now, book value is given 2,000. Then sales are given 5,500. Similar type of companies are E, F, and G. Now, all the values of this E, F, and G are company are given. First, we will find the multiples of this company and then we will put the value on this company. So, how to find the multiples? Company E, company F, company G. Sales are given of every company, EBITDA, book value, enterprise value. 3 valuation multiples are there. Again, in the same manner, just like what you have done over here. Similarly, the same thing you have to follow here also. EV upon EBITDA, what is EV? 3,000 upon EBITDA is 400. If you will divide, you will be getting this value. Similarly, you have to find the value, the EV upon EBITDA multiple of company F. 4,000 upon EBITDA is 5,000. So you will be getting 8, 10. Similarly, company G, you will be getting 10. Now, what is the average? See, here average means what? Don't take the 3 companies are given, so you will divide by 3. No. In this case, in valuation multiples model, okay, if you're finding the enterprise value to book value, sales, EBITDA, what you will do, you will find the midpoints. Here average means what? The midpoints. So what you will do? 7.5 plus 8 plus 10, you will divide by 2. If you will divide by 2, you will be getting this value. Okay, let's check it once. 7.5 plus 8 plus 10. Now, so this value is getting. Similarly, here also 3.33 plus 4 plus 3 divided by 2, 5.165. Similarly, here also. Now, these are the average, the midpoint sort of the companies. Now, using this midpoint, you will find the multiples of the company. So, average is what? 12.75. EBITDA average. Now, book value average is what? 5.165 and sales, that is 3.5. Now, EBITDA of M is given what? 500 crore. See, in the question it is given 500 crore, 2,000, 5,500. So, similarly, we will put the values. Now, what is the value? 500 into 12.75, 6375 you will get. In this way, you will get. Now, if what value the purchaser will take from 6375, 10,330, 19,250. Definitely purchaser will think that I want to acquire this company, so the least amount I should pay. So which amount the purchaser will go? The purchaser will go for this 6375 crore. On the other hand, what seller will do? Seller will think that if I am selling my company, I should get the more highest amount. So what amount on what amount the seller will get convinced on this amount? So purchaser is ready to give this amount, seller is ready to give this amount. So in order to avoid the conflict, what the midpoint, what the mid solution is that let's do the average of these companies. So here 6375, then 10,030, 19,250. Here you will be doing the average, you will be getting this value. Now this is what the value that company M has to pay to whom? To the acquirer company. So this is how they will find the multiples of companies. Now, so next we have equity multiple model. Equity multiple model means to find the value of equity of a company. And multiple is what? It is the ratio which helps the company to compare from one company to another company. Types of multiples in equity valuation model, we have different types of multiples. First is price to earning ratio. Again, price to earning, we have done before also MPS upon EPS. Then price to book value, market price, MPS upon book value per share. That how much investors are willing to pay for 1 rupee of net to the company. And what is the value of your one share in the market? How many times of earning investors are ready to pay for the share? That is MPS upon EPS. Now, similarly, price to sales ratio, market price per share upon sales per share, MPS upon sales per unit. So this is the question. Okay, you have to find the PE multiple. Now, PE multiple is what? MPS upon EPS. This is what the PE multiple. But if you will see the question, in the question, if you will see that the multiples are given the different value. Okay, so see, if you will see that return on equity is given, then it is 20%, R is given 15%. Now, PE multiple, the fundamental determinants of PE multiple is what? P upon E is what? It is 1 minus B upon R minus ROE into B. Now, this is what? This is the formula. Okay. One thing, let me make you very clear. See, wait. B is what? What is B? B is said to be retention ratio. Now, there are two types of ratios. One is retention ratio and one is dividend payout ratio. Okay. Okay, I'm explaining over here. Now, one is retention ratio and one is dividend payout ratio. Now, retention and dividend payout is when company makes profit, from that profit only company will pay dividend to its shareholder. If what, company will keep some of the earnings as retained earnings also. Now, retention ratio is described as the money which you have kept as reserves in your company, that is a retention ratio, and it is described as B. Tell me, if B is, let's take an example, the total value is 1. If I say B is 20%, then what would be the dividend payout ratio? If B is 20%, what would be the dividend payout ratio? Because total is 100, 20% is retention ratio, then 100 minus 20 would be what? 80 would be what? Your dividend payout ratio. So can I say dividend payout ratio is 1 minus B? We can say that retention ratio is described as B. It is determined as B. Dividend payout ratio 1 minus B. Now, so if return on equity is 20%, ROE is what? 20%, we can write 0.20. R is what? That is 15%. Required rate of return R 0.15. Dividend payout ratio is given 0.3. If dividend payout ratio is 0.3, then retention ratio is what? Total we have 1. 1 minus 0.3, that is 0.7. Yes, if you will put the values over here, you will be getting PE multiple. Done. So we can write 0.3 upon what is the R? 0.15 minus return on equity 0.20 into what is B? B is 0.7. So let me calculate. that is 0.7 to 15 is equal to 30. Clear? Okay, so B is retention ratio, and another name of retention ratio is what? Plug-in back ratio. Plug back ratio. Now, next is, this was the PE multiple. Now, next is what? That is PB multiple. Price to book value. So, market price per share upon book value per share. Now, fundamental determinants of PB multiple is what? ROE into 1 minus P. 1 minus P is what? Dividend payout ratio. And R is required rate of return minus the G. G stands for the growth rate. 1 minus B, dividend payout. R is required rate of return and G is growth rate. So this is the formula of your PB multiple. Similarly, the price to earning we have already seen. Now, the PS multiple is price to sales multiple. The formula is given to you. What is the formula? That is NPM. Okay, net profit margin. Net profit margin. 1 plus G, 1 plus growth rate, 1 minus B, dividend payout ratio, and required rate of return minus G. So what is M? 0.10 up into 1 plus G. 1 plus G, 1 plus, we can write growth rate 0.14 into 1 minus P is what? That is 0.4% upon small r is what? The small r represents your 0.19 minus growth is 0.1. So if we calculate, that is 0.10. We can write 0. This we can write 1.14 plus 2, 4. Five. That is 0.913. Okay, so this is your answer of P, price to sales multiple. Now, relative PE ratio, what is a relative? Relative means describes the relation. So it will tell you that your price to earning ratio, what is the relation to your price to earning ratio? So price to earning is high or price to earning is low. Means the value of your market per share, okay, the value of your shares in the market, it is overvalued, it is undervalued, or it is actual paid. Actual means the fairly valued. This is fairly valued. So whether the price of your shares in the market, it is overvalued, it is undervalued, or it is fairly valued. So relative PE, the current PE ratio firm divided by current PE ratio market. Now, if relative P is greater than 1, stock is expensive compared to the benchmark, means the standards. Expensive, it means the stock is overvalued. Stock is cheap, it means it is undervalued if it is less than 1. And if it is equal to 1, means it is indifferent. It is fairly valued. Means the value of your stock in the market is 10 rupees and the value of your stock, the company is having 10 rupees. That is, stock is what? The fairly valued. Now, enterprise value multiple model, EV multiple model. Again, EV enterprise value, what it consists? It will consist your debt and your equity. Okay, so market value of your equity plus market value of your debt, and you will deduct all your cash and cash equivalent. So this is your enterprise value multiple. So enterprise value represents total value of the business calculated as market value. In that, equity will be there, debt will be there, minus cash and cash equivalent. So this is the formula. Now, market value of equity is what? That is what MPS do you have? A price per share into all your shares outstanding. Company's shares outstanding, that is market value of equity. Debt includes both the short-term debt also and long-term debt also. Okay. Long-term and short-term debt is like working capital loan is the short-term debt, and term loans are what? Term loans are your long-term debt, and cash equivalent. So this is all about enterprise valuation model. EV upon EBITDA, EBIT, FCFF, free cash flow to firm, book value, and sales. So EV upon EBITDA, this is the formula. ROIC, return on invested capital minus growth. 1 minus DA is depreciation and amortization. 1 minus the tax rate. WACC, weighted average cost of capital minus D. This is the formula for EV and enterprise value upon EBITDA multiple. Okay, all the formulas are important. Similarly, we have EV upon EBIT. This is the formula. 1 minus T into 1 minus reinvestment rate upon WACC minus D. See, all this we have already done several times. FCFF formula, that is 1 upon WACC minus D. G is what? The growth. Now, free cash flow to firm means what? After paying all your debt and liabilities, what cash you are left in your company, that is free cash flow to firm. The firm is having that cash. EV upon book value, ROIC, return on invested capital, the formula we have seen just now, minus growth upon WACC minus growth. Now, suppose question is given, Vivek company ROIC is what? 18%. We can write 18 as 0.18. Growth rate is 11%. We can write growth rate is 0.11 and WACC is 0.13. Now, you have to put the value on this. ROIC is 0.18 minus growth is what? 0.1. Divided by WACC is given 0.13 minus 0.1. See, this both are same. If you will calculate, the 3.5 is what? It is the multiple of EV upon book value. Similarly, we have for sales also. See, if you will see, EBITDA, EBIT, FCFF, BB. Now sales. Enterprise value upon sales. What is the formula? Inter value upon sales. Now determinant. The formula is what? After tax operating margin. 1 plus G. G again growth. Investment. Growth rate. Reinvestment rate upon WACC minus growth. WACC is overall cost of capital. Weighted average cost of capital. Now, plant limits after tax operating margin is 11%. We can write 0.11 into 1 plus T. 1 plus G is 0.09 the growth into 1 minus reinvestment rate. Reinvestment rate is 70%. We can write 70 as 0.70 upon WACC is what? 14%. So WACC minus growth. All the formulas are very, very important. I have already provided you the separate formula of module B and module C. So please go through once before your exam. Okay, at least in the morning, go through once these formulas. Like the questions will come like this one, and if you will know what the formula is, then only you can put all the values on the formula. Clear? Now, next unit is unit number 16. So we have done unit 13, unit 14, unit 15, and now unit 16. Now, unit 16 is all about special cases of valuation. See, special cases of valuation are what? See, there might be some companies which are related to your real estate companies. Okay, you want to do the valuation of such companies, real estate. There might be some companies who is continuously making losses. You are purchasing that company. There might be some companies who are of distressed nature companies. There might be some companies who are new startup companies, startup-based companies are there. The financial services companies are there. If you are purchasing these companies, if you are acquiring these companies, you have to do the valuation, okay, in a bit different manner. So these are those companies that will come under the special valuation cases. Okay, so you will do the discounting of these companies, the discounted cash flow techniques you will apply here also. Now, so approaches for valuation are what? The first is capital investment. Capital investment means what? That is the investment which you have made on your huge assets. Okay, like you have purchased your assets, you have done the repairing of your assets, you have spent on advertising, you have spent your money on market promotional activities. So all these will come under capital investment. Now, next approach is what? Discounted cash flow valuation, that you will do the discounting of that company. You will do the discounting with the help of cost of equity, with the help of cost of the CAIIB model, with the help of the you can say this back. So different tools, techniques are there to do the discounting. Ability to discount the anticipated increase in cash flow. Then relative valuation means what? That is the you will find the value of relative. You will find the valuation of the company which is related to the target company. That is simply relative valuation is what your comparable companies. This we have seen, na? Comparing the market value of a company to the market value of company that are similarly similar. Okay, that are similarly similar. You will compare from those companies. So for real estate firm, how to do the valuation? Discounted cash flow valuation. First, you will estimate the discount rate. How you will estimate the discount rate? With the help of risk-free measures. See, there are certain measures to there are certain key factors to measure your discount rate. How? First is risk-free rate, that is RF. Okay, then beta. So for that we have the CAIIB model. RF plus beta, RM minus RF, that is the cost of equity, the CAIIB model, estimating the discount rate. So RF is your risk-free interest rate. Risk-free interest rate is what? Like your government bonds. These are what? Risk-free interest rate. Beta is what? The risk of the company, the systematic risk of the company. RM minus RF, what? Market risk premium. RM minus RF. These together, RM minus RF is what? Market risk premium. Okay. So in this way, you can do the discounting. This way, you can find the discounting rates. Then cost of equity. So cost of equity is what? It is determined by the risk of an asset and it cannot be reduced by diversifying. If you will diversify the equity, okay, their price, so the risk will never be diversified in this case. So like we will use CAIIB model, the arbitrage pricing model. Now, the third is what? That is, are the marginal investors in real estate well diversified? See, the question is that the investors who are investing in real estate type of business, will they going to diversify their risk in real estate firms or they will take the business in the same manner? So this is the answer for your given question. So in real estate business, many analysts, okay, many researchers, they believe that real estate investors usually are not well diversified. If they have taken any particular thing, okay, then they will not going to invest in different projects. If they have thought that they will invest in stock of real estate, then they will only invest in stock. Okay, they will not going to invest in different new sort of stocks or new sort of technology. So they believe that not usually well diversified because they need large amount of investment. It makes hard for small investors to spread their money. That is why they will invest only in one property. Investing in real estate requires special knowledge. So those see, you will be seeing those who are working as a real estate, okay, owner or real estate firms. They are not they were not going to invest in different properties. Okay, those properties that will give them the actual amount, the fair amount. Only they will invest in such property. And likewise, see, we invest in 10, 12, 13, 14 different shares we will going to purchase of the companies, but real estate, they have to invest a huge amount in that. That is why it becomes quite difficult for the small investors to invest in big properties. Now, and it requires special level of skill. Because of this, model like CAIIB will not work since they assume investors are diversified. And in CAIIB model, there is the risk is diversifiable. And here only non-diversifiable risk matters in real estate. Now, but this argument is not fully correct. Why? Because many investors, they will choose to concentrate on real estate. It can be broken down into smaller parts. With small one property will be divided into small properties. So all these are the reason they will not diversify their risk. Now, again for startup firms, what we have for if doing the valuation of the startup firms, first certain questions you have to ask. The step-by-step process you will take to invest in those companies, okay, to do the valuation of those companies. First, assessment of enterprise current standing. Now, first you will assess that the startup companies, what is the current earnings of these startup companies? Okay, current earnings of these startup companies. Then you will ask that what is the estimation of revenue? What revenue you will going to generate from this company? Okay, the revenue growth estimation is high revenue growth is there or low revenue growth is there. Then stable growth. Okay, the company will say that my revenue growth estimation is 10%. But if I will make the stable growth, I will not let it down the growth from 8%. My stable growth is 8%. I can make 10% more than that, but not below to 8%. Then estimating reinvestment, that whatever money you will earn from the startup companies, you will going to reinvest in the companies for its growth. So reinvestment to generate growth, two formulas are given. Expected growth reinvestment rate into ROC, and reinvestment rate is what expected growth upon ROC. Then you will determine the risk and discount factors. You will find the valuation with non-operating assets. Okay, estimating equity value per share. So this is all the steps. Okay, if you will bifurcate these steps, so you will going to follow that every step they consist of different sub factors also. Yeah. There are certain companies you will going to do the valuation. Those companies will be of negative or low earnings. So why anybody would purchase any company that is giving them the low earnings or giving them the negative earnings, or they are of distressed nature, just to save the tax, just to get the tax benefit. Okay. See, if like you are purchasing company who is already in loss. Okay, loss of 10 crore rupees. Now, when you have purchased this company, this 10 crore rupees now you have to settle down in your company, and you have made already the huge profit in that company. See, we know that the tax is what? It is progressive in nature. The more you will make the income, the more tax you have to pay. It is progressive. So if the company has made more income, and if company has made the income of 40 crore, and this company has made the loss of 10 crore, then why would this company X will purchase company Y? If they will purchase company Y, then they have to set up this 10 crore plus minus 10 crore. So now 30 crore will the value of this company X will be. Now in this, the value on 40 crore, what tax you have to pay. Now you will pay the tax on the 30 crore only. Why? Because you have already settled off the loss of this company. So that is why the companies, big companies, they purchase low earning companies or negative earning companies just to get the tax benefit, just to show their tax liability less. Now, so value loss making firms, when a company has negative earning, what are the reasons behind these losses? Company facing momentary challenges. Okay, what challenges the company are facing? Are these challenges unique to the company only or unique to whole industry? What issues, long-term issues are there in the company? Like the strategic issues are there. Two cases are there. We're going to see that Kodak case and the IBM case. Then what is the operating issues? Company is making the regular profit or not? Okay, they are doing their regular business in the proper manner or not? The size of the company, it should be not that the size of the company is very big and you are hiring only few people in your company. So company size will also matter, and the people. Inefficiency, workers are not doing properly their work, they are not completing their task, they are inefficient in the production process. External limitation, that is all about your strength and weakness of your company and the pestle and the quality of management. If your management is not good, if your top manager is not good, if the top manager is unable to take decisions regarding the company, then the company will make the loss always. So that is why it is important that whatever management of the company is, that management should be a rational person so that they can take the quick decisions of on that company. Now, so this was the Kodak case. The case study can come in Kodak case, in IBM case, and in the case of Xerox Corporation. Okay, so let's do one by one. Now, Kodak case is what? See, Kodak, okay, I'm explaining you in short. Now, what is this Kodak case? The Kodak is what? The camera. Okay, you have heard of Kodak. many years before. Now, this Kodak case was thinking to acquire what? Fujifilm. Okay, its greater competitor. So Kodak was busy in making plans, in making plotting how to acquire the Fujifilms. Okay, they were working on the camera. Fujifilms are also working on the camera, and Fujifilms the biggest competitor of Kodak, and it was famous in different you can say areas. Okay, in different countries, the Fujifilm was famous. Now, Fujifilm was busy in in enhancing their camera quality, in making their camera more good. Okay, they were examining a digital camera, but Kodak, on the other hand, they does not study the market properly. The Kodak was busy in acquiring the Fujifilms. Later, what happened that Americans would always select it over Fujifilm's technology. Technology in market changes, and it derailed the strategy of Kodak. So Kodak's strategy was completely uh, got in vain. Kodak spent money on acquisition. It was busy on in acquisition process, whereas Fujifilms they made a lot of profit from their digital camera. Now, when Kodak could understand this, it was too late. Kodak could not compete with the big companies at that time, and in 2004, Kodak declared it would end the sales. And if their sales were end, then they have to reduce their workers. They have to reduce their 15,000 workers, and their shares went down. So this is the biggest mistake the Kodak made at that time. Kodak could not understand the market need, the customer need, the technology need, and it could not make its camera more impressive, more enhanced. But on the other hand, Fujifilms they have done the tremendous work on their camera. Similarly, IBM case at that time, IBM was the only company who can make the operating system. So what happened? This company sold its rather than selling its own operating system, this company sold its operating system to Microsoft. Now Microsoft has taken over what IBM. So IBM has the capability to develop operating system. Now instead of choosing to seed the business, newcomer named Microsoft, IBM has sold its operating system to Microsoft, and Microsoft has erased the name of IBM from the market. So this was the second mistake. The second case that IBM has done. Similarly, Xerox Corporation, it could not understand the market. Okay, it failed to make the digital, you can say printers. Okay, new type of printers. It was only making the one or two type of printer. So in this way, also the market collapsed. The market got failed. Now, if you are to do the valuation of financial services companies, what certain things you have to do consider that the special features of financial service companies use of debt to more income, then it is very heavily regulated sector. Why? Because regulations are very higher in this. Different regulatory bodies are there. You cannot compare one bank to another one. You have to maintain capital adequacy norm. You have to maintain more provisions for your NP. So difficulty in choice in making multiples. You cannot compare two banks, okay, each other. You cannot take the multiples of another bank and you can apply the target bank. So capital adequacy norms, difficulty in choice of multiples, provision is very high, and government directions are very high. The regulated, fully regulated sector. Now distressed firm, again the same type, okay, the loss bearing company. Now, next is consolidated and separate valuation. Now, what is consolidated and separate? Consolidated means mixing of things together, and separate means entirely different, individual. Now, so consolidated means this approach. See, why consolidated valuation is helpful? It values the entire company as a whole, including its subsidiaries. See, what happens? Suppose parent company is there. Now, this parent company is having its four subsidiary companies. Let's name parent company as A. Now, A1, A2, B1, B2. There are four subsidiary companies under this parent company A. Now, if you will separate, if you will do the valuation, what will happen? You will do the valuation of A1, A2, B1, B2, separate balance sheet, separate financial statements. So it becomes quite difficult for the company to understand the whole scenario or the auditor to do the proper audit. So what happens if one company is there, under that company, if many companies are related, it has its subsidiaries, then it is important that you should do the valuation at one time. And that is known as consolidated valuation. This method is useful for companies with fully owned subsidiaries, more than 50% ownership. And separate valuation is what? When you are in this approach, different parts of the companies are valued individually. Which type of company? Who is having the value less than 50%. Now, cash and cash investments are what? See, we need cash for every purpose. Either we are purchasing raw material, or we are we are doing daily expenses. Okay, company need a regular cash. They need a regular cash for any unexpected expenses, like if any kind of fraud are or have arose in their company, or the natural calamities is there, or sudden death of any employees is there. So they need cash for all those activities. So on every company's balance sheet, there is section for cash and marketable securities. And this includes actual cash, short-term investment, and it can be converted into cash, the liquid money like government bond or commercial paper. So commercial paper is what? This is issued to high net worth individuals, issued only companies. Company can issue this. So government bonds or commercial paper. Now, John Maynard Keynes identified three motivations for individuals to hold money: for transaction, for protection against unplanned activities, and for speculative purpose. Speculative purpose means that is for making profit from price differentials. From price differentials. The arbitrage, speculation, hedging, all these things. Now, for daily operation, we need money, unexpected expenses, investment opportunities, and for management decisions. For all these things, we need extra money. Now, so we have completed this unit also. Now, next unit is unit number 17. That is all about mergers and acquisition. Very important unit. Now, what is merger? Merger is when two companies are merging together and one company's existence is there. Suppose A and B companies are there. If A is merging into B, so B's existence will be there. If B merges into A, A's existence will be there. That is, see, no new company is formed. They are merged together to form one single entity. Combination of two or more companies into single entity. Why they are merging together? Just to make more efficiencies, expand their market. Okay, similar type of companies are there with similar size, so they will work together in a more advanced way. Types of merger are what? Horizontal. Horizontal merger when two companies are merging in the same type of business. Like two food making companies are merging together. That is horizontal. Two automobile manufacturers are merging. Vertical when companies are merging at different stages of the production process. Means they are in the same type of purpose, same type of business, but their stages of production is different. That is vertical. Like car manufacturer is merging with its part supplier or the component making company. That is vertical. Reverse is when an unlisted company purchases the listed company, or when any short company, the small company purchases the big company. That is called reverse merger. Acquire, purchase means acquire. Now, conglomerate merger is what? When two different kinds of companies are merging, but they are related in unrelated industries. Their business is completely different. These two companies are merging together, conglomerate, like food companies merging with technological company. Market extension is what? When companies are merging to expand their market, to expand their geographical area. That is called market extension. Co-generic company is what? When companies are merging, okay, either in a related industry or in uh, that operate in related industry, okay, like the same car plus car manufacturing business plus car component making company, they are merging together. That is co-generic. So company that manufactures home appliance may merge with a company that makes component like motor or circuit. Clear? Now, acquisition is what? That is acquiring company. Two companies are there. Company A is acquiring company B. So company B will become the target company and company A becomes the acquirer. So the one who is acquiring, that will become the acquirer, and the one who is getting acquired in that company becomes the target company. So two types of acquisition is there. When both companies are agreed that yes, I'm ready to get acquired into you, or if acquirer company is acquiring me, if there is, you can say the agreement is done. Okay, uh, both are okay with the agreement. That is friendly acquisition. That agrees to the acquisition. The target company agrees to the acquisition. When target company is not agreed for the acquisition, it is known as hostile acquisition. When target company does not want to be acquired, it is hostile acquisition. Now, different reasons are for acquisition. Either you want to expand your market, that is why you are acquiring. You want to diversify your products, diversify your risk, diversify your uh, services, your customer base. For that, cost synergy. Now, what is synergy? What is synergy? Synergy means the extra benefit. What extra benefit? If I say that value of company A plus value of company B, it will always be high than the value of company A working alone, value of company B working alone. When two companies, they will work individual, what income they will generate, that will always be high when two companies are together, coming together and working. So if value of company is A is 200 crore, value of company B is 200 crore, then together their value will always be higher. It would be 500 crore. If it is higher, then only that there is synergy, otherwise no. So synergy to achieve economies of scale and reduce cost for strategic growth and for eliminating competition. Like if companies are merging together, where there were 10 companies, if these 10 companies are merged together, then only 5 companies are left. So for reducing competition. Now, detail for amalgamation. See, amalgamation is one word, that is what? Amalgamation means when two companies are combining together to form entirely a new company, that is called a C. When company A and company B, they together come to form new entity, that is company B. Now the existence of company A and company B is totally lost. New company has been formed, that is company C. For amalgamation, the legal proceedings are required. Okay, it is a bit long process. Now, what are the proceedings? These all are the proceedings. First, you have to do the analysis. You have to find the objective. Okay, why you want to do amalgamation? What is the reason behind that? In-depth analysis of the object process. Then you have to give the intimation to the stock exchange. You have to communicate to stock exchange. But see, if companies are listed on the stock exchange, then you have to provide the information to them. Then when board of approval, um, if they approve, if they say that yes, you can do the amalgamation process, then only the proceedings will go. They will be followed. Otherwise, not. After board approval has said yes, then application will be given to NCLT, National Company Law Tribunal. Then notice to shareholders and creditors will be provided. Meetings of the notice will be given to them. Okay, petition will be filed on passing orders. When they have filed the, you can say, order copy with the registrar of company, then all the liabilities and assets will be transferred, both the companies to the new company. And in that new company, who will become the shareholder, who will be given the equities, who will be given preference, all these will be decided after the company has been formed. Now, next we have that is cost and benefit of merger. So what is cost and benefit of merger? This is just because of synergy. Now, synergy again, I'm writing value of company A and B will always be greater than value of company A alone plus value of company B alone. Now, so when company A decides to buy company B, the decision affected both the companies. And it is how we can know that. We can look this with the help of net present value. Now, how to find net present value for each of the company? Now, benefit of merger is given. Benefit means what? When two companies are merging, what is the benefit? What is the extra money they are getting? That is the benefit of the merger. Cost of the merger, when companies are merging, what is the cost they have to pay? That is the cost. And after that, we will find the NPV of company A, NPV of company B. So this is all about the question given to you. Firm A has a value of 100 crore. Now, Firm A, the value of firm A is 100 crore. Value of firm B is 25 crore. If two firms are merged, cost saving with the present value of 225 crore would occur. Now, if these two companies are merging together, again we know that the synergy is there. So if two companies are merging, 125 crore is there. But cost saving is how much? 25 crore. Means company A and B together is 150 crore. How 150? 125, this is the value, plus 25 crore more, that is 150. Now, firm A proposes to offer. See, what happens when any company is acquiring, okay, that company has to pay some amount for to the target company so that they can do the repairment, okay, of their company, they can pay the extra debt and all that. Because ultimately the company who is acquiring, they have to pay the debt. So firm A is what? Firm A proposes offer to 30 crore. So the cost is what? Firm A is given cost 30 crore to acquire firm B. That is to acquire firm B. Now, how to calculate the net present value in this case? See, value of company A given 100 crore, value of company B 25, total value 150 crore, cash offer to be 30 crore. Now, what is the benefit? Benefit is given. Okay, benefit is present value of company AB. That is what is the present value of total 150 crore minus company A value is was 125 plus 25. It was 100, no? Yes, 100 plus 125. So that is benefit of the merger is 25 crore. Now cost of the merger is cash minus PV. How much cash is given? 30 crore is given. PV value 25. Then what is the cost? That is 5 crore. Now NPV for a present value of the companies, that is 150 crore was there. Company A 100 value, company B 25 minus cash was how much given? Cash, it was given 30 minus company B, it was 25. So 150 minus 125 minus 5. So it is 150 minus 120. So that is 30. So NPV for A is what? Wait, 25 given. 150, 100 plus 25, 30 minus 25, 5 crore. Okay. Present value of company A given 100 plus B, that is 125 minus 30 minus cash is how much? That is 30 minus 25. It is 5. Wait, is there I'm making any mistake, I guess. Okay, if you will do benefit minus cost, that is benefit minus cost is how much? 20 crore. Yes. And NPV for B is 30 minus 25 crore, 5 crore. It is 150 minus present value is 100 plus 25. Still the answer is coming 30 crore. Okay, NPV for B is 30 minus 25. That is cash minus PV. What is the value of the cash? That is 30 crore minus PV, that is 25 crore. So NPV for company B is what? That is 5 crore. And NPV for A, it is 25 minus 5 crore. But I need to check this. It is 25. $150 minus 125, it is 25 crore, okay, and 30 minus 25, it is 5 crore. Okay, see, 125, it is coming, okay, 150 minus 125, it is what? 25 crore. And this is the big one. First, you have to calculate this. Then 35 minus 25, what it would be? That would be your 5 crore. So 25 minus 5 is what? That is 20 crore. Clear? Okay, done. Now understood how it would be solved. See, first with BODMAS rule, what we do first, we solve the big bracket, then then next the small bracket. So first we have to solve this, then this. Okay. Now, so company A gains 20 crore and company B gains 5 crore from the merger. Now, next is what? That is the takeover. Takeover again. Takeover is done through acquisition also. So takeover is done through following this: open market purchase, negotiated acquisition. Negotiated acquisition means seller is asking for different amount. Buyer is saying that in a different amount I will purchase. So this is what the negotiation is done between the seller and buyer, between the acquirer and the target company. Now, next is preferential allotment. Preferential means preference is given. Preference is given what? Like selected group of investors of the company, they would be given the shares at a discounted price. Means a certain preference is given to them so that the more and more shares will be there and we can raise capital from that shares for the company. That is a preferential allotment given. Now, what are regulations for existing companies? Again, takeovers are it's useful for companies to gain the control, to expand your market, okay, to be cost effective, to make goods and services in a more effective manner. Okay, everything should be transparent in the company. The fairness should be there. So that is why takeover is done in that case, and it needs to be properly regulated for the fairness. That is, the fair price should be given to the share, to the value of shares. Transparency should be there. Protection of minority shareholder. Those shareholders who are not at all indulge in the activity of acquisition or takeover, still you cannot leave them behind. Okay, those who are not the part of the takeover, still you need to protect them. And prevention of abuse, that is, no any kind of manipulative practices or unethical practices will be there in acquisition and takeover. Now, so for this, for acquisition, the excuse me. Now, for takeovers and acquisition, it is required that you need to see the regulations. Okay, what regulatory bodies are saying. Now, SEBI takeover code, you have to intimate to the stock exchange, and whatever their regulations are, you have to follow that regulation. So this is very, very important. First is what? The disclosure. Disclosure 5% rule. Now, what this disclosure tells you that if any person or company is buying the company 5%, acquiring that company 5% or more of the part, then they must have to inform to the this SEBI, Securities Exchange Board of India. Now, what trigger point? If anyone is purchasing 25% or more than that of the company, then they have to make the public announcement. Now, if 5% or more than the acquirer is acquiring, so then they have to inform to the SEBI. If it is more than 25%, 25% or more than that, then they have to make the public announcement. They have to tell everybody that yes, I'm purchasing this company worth rupees sales at this time, at this predetermined price time, everything. Why? To give other shareholders a chance so that they can sell their shares after. If any other shareholders they also want to sell their shares, they can also come forward. For this, merchant banker is appointed. Okay, merchant banker means the one who is having the experience, good level of skills, must appoint SEBI approved expert. The person company buying must appoint SEBI approved expert to make rules are followed, to see that rules are followed properly or not. Then after that, public announcement has to be made within 4 working days. The acquirer must announce the public that at which price, who will going to buy, how they will pay the money. Offer price will be given to them that this is the offer price. Okay, the buyer will offer to the public shareholders. Then responsibilities to the acquirer after announcing the offer, the buyer have to send a proper letter. Okay, in that letter, everything has to be mentioned, and that letter will be sent to the shareholder within 45 days. When the offer price is decided, then they have to send one letter to the shareholders within 45 days that who is buying the company, at what rate, what is the payment method. After that, what is the obligation of the board of the target company? Okay, if someone announces that, yes, I'm ready to buy the company, okay, they want to buy the company, or I'm ready to purchase the company, the board of directors cannot sell its major asset. When it's decided that A will acquire the target company, now the target company cannot sell off its valuable assets to any other company. What happens? See, acquirer is acquiring the company, so they are seeing na, that you have the valuable assets in your company. So in that case, what target company can do? Target company can sell their valuable assets to some other company, so to make the profit from there also. And if the acquirer will give them the money, that will also. So in this case, the after someone announces they want to buy the company, the board of directors of the company cannot sell their major assets, issue new shares, and they cannot sign big contracts. Then bids, if anyone else they want to purchase the company, they can come forward. Okay, they can also make the offer to buy the company, but that should be within 21 days after the first offer is announced. After the offer is announced that this company is yet to be acquired, okay, then after that within 21 days, the another competitors, if they want to purchase, they can come forward and they can purchase to give higher price. Then if decided, okay, at what amount you will going to acquire the company, you will purchase the company, the seller is okay to give their company. In that case, whatever amount is that, okay, let's take an example. The deal was of 10 crore. Now, this 10 crore has to be put in one account, and that account is known as escrow account. This is the third party account, not buyer is included, not seller is included. A third party account is there to keep the money safe. The buyer must keep some money in the special bank account known as escrow account. If the value is up to 100 crore, the buyer is required to keep 25% of the amount in escrow account. If the value is more than 100 crore, then whatever value is more than 100 crore, its 10% is required. Suppose it is the company is sold for rupees 150 crore. Now, up to 100 crore, 25% of the account is transferred in this escrow amount when the offer is made. 10% extra if the offer is made 100 crore. So, how much extra? 50% extra is there. 50 crore. So, 50 crore into 10% will be kept under escrow account. Why this is done? So that shareholders, they are sure that buyer has enough funds to complete their purchase. Now, what is creeping acquisition? Creeping acquisition means going very slowly. Okay, if any person has already purchased your 15% of the company, 15 to 75% of the company, they are allowed that they can slowly go to rest of the part of the company they can purchase. If anybody has purchased to 20%, next year they can buy up to 5 more percent share, means 25. Then next year, more 5%, more 30%, without making any public offer, without intimating to the public, without intimating to the SEBI. They can increase their holding gradually and slowly. If someone is already owning 55% to 75% of the company. 15 to 75. Now, restructuring. Restructuring is what? Like if company, they want to change the policies of their company, they want to change the pattern of their company, they want to change the business model of their company, they want to change the, you can say, the hierarchy level of their company. So if any restructuring has to be done, there are three types of restructuring. The corporate restructuring. First is organizational, second is financial, and third is operational restructuring. Now, organizational restructuring, when you are changing the internal culture of the organization, organizational. Financial restructuring is when you are making changes in your debt, in your equity, that is financial, and operational in your day-to-day business activities. So this is all about your restructuring. Now, in takeover, what happens? The takeover defenses are there. Okay, like if there is any kind of hostile takeover, okay, hostile takeover is there, then what anti-takeover defenses are there? So these anti-takeover defenses are given at two ways. Before an offer is made, it is called pre-offer defenses. These strategies are divided into two main types. Pre-offer defense before an offer is made and post-offer defense after an offer is made. Now, pre-offer defense is what these actions are taken before the takeover bid is to make. Before the action is to be taken, the pre-offer defense. Okay. Now, first is staggered board. Now, what is staggered board? The board of directors is divided into three groups. See, staggered board is what distributing powers to the board of directors. That is dividing powers to the board of the directors so that the acquirer company gets confused that sometimes this is the board of director, after 2 months that is the board of director to whom I can reply, to whom I can ask for the money, whom I can make the decision, okay, with whom I can make the decision. So that is why what happens, it creates confusion in the mind of acquirer. Now, next what we have, that is supermajority clause. So supermajority clause is what, see, if majority voting is there, then only the acquirers can acquire the company. If majority voting is over 80%, it is more than 80%, then only they can take the decision. A very high percentage is required for doing anti takeover defenses. Now, next is what, that is poison pill and poison food. Now, shareholders are given the right to buy the shares at discount. What happens? See, if shareholders are given the right, that the existing shareholders, they will be given the shares at a discount. So if at discount they will be given the shares, then they will purchase more share. And if they're purchasing more share, so now the company is becoming more expensive. Why? Because every shareholder is having lot number of shares. It makes the company more expensive. Okay, so I'm giving right to buy bonds to my own shareholders of the company. In exchange of bond, company is getting what? Company is getting funds. So there is no offer left to the outsiders. Now, next is what, that is poison put. Poison put is what, the target company issues bond that can be redeemed early. So the redeemable bonds are provided to this with put option. Okay, so when I purchase my own share, it will become the less attractive to the bidder. Then dual class are there, new shares are given. Okay, new shares are issued to the shareholders, which will give them more control. And if the shareholders are having more share, then it means that the acquired company, they also have to give the share, their share. They also have to give that much shares to the shareholder. So that is why it becomes expensive for the company. It will become expensive for the acquirer, and at last, what acquirer will do, that the acquirer will they will remove the thought from their mind that they have to purchase this company. Now, next is what, that is golden parachute. Golden parachute is what, a type of, you can say, a special deal is there. Now, what does this deal says that, suppose you are the manager of the company. Okay, if you are the I'm the CFO and you are the CTO of the company. Okay, now there is already one bond or one document is being signed that if anybody, if I'm leaving the company, or if anybody is laying off, okay, me from the company, then I will get 10 crore on this, on behalf of this. So here the top bosses get a lot of money, okay, or the benefits if they are leaving the company. Or if that company is bought by another one, then they have to given a lot of money. So that is what in the agreement it is written, in the document. It is already written that if somebody purchases the company, that then The one who is purchasing the company, that will give me the extra amount. So it is one golden parachute for the managers, okay, so that nobody can purchase their company. From the hostile takeover, they can prevent themselves. So it is a special deal when a company's top bosses get a lot of money or benefit if the company is bought by another one. So the other party will say, the acquirer will say that I have to give the 10 crore rupees to this person if I am purchasing the company, so it's better I should not purchase this company. So this is the way to stop unwanted takeovers. It will what? It will scare them off. The manager and staff both will get a lot of benefit. So both manager and staff. Here the anti-takeover defenses now. Similarly, next we have what? Post offer. This was what? This was the pre-offer, when the offer was given before that. Okay, before the offer was given, the action are taken before the offer is given to them. After the offer is given, how you can defend at that time your company? Then next is green mail. Green mail is what? That you are convincing the acquirer. The target company is buying back its share from the bidder at the premium. Suppose the acquirer has already given the offer that I will purchase the target company. Now in this case, target company is buying back its share from the acquirer at premium. Acquirer has taken the company worth rupees 100. Now target company is acquiring their shares worth rupees 150 or 120, buying back the shares from acquirer. Now Pacman defense is what? There is counter bid offer. Counter bid is acquirer is saying that okay, I'm purchasing your company worth rupees 50 crore. Now target company, what in that case will do? Target company will say that I'm giving you 80 crores, you give my company back. That is what the counter offer. Okay, counter offer is given. I will give you 80 crore, you give your company to me. Then litigation, if the target company will say that this company is not following the proper rules, proper regulation, okay, I will not let my company go in the hand of such type of people who are not following the rules and regulation, they're violating the laws, then litigation. Restructure asset, that if target company sells their most valuable asset to another one, okay, that is the example of restructure. Like if target company has a lot of assets, okay, the valuable assets. Now, if those valuable assets are sold to another company or given off to another company, now what will happen? The company value will go less, and if the company value will go less, it make less attractive to the bidder. Now, the acquirer will purchase the company. That company is having the low valuation. And restructure liabilities, that the target company is buying back the shares or issuing new shares to another friendly company, making it hard for the bidder to gain the control of that company. If you are issuing more shares to the new company or the friendly company, then what will happen? The value of your shares will go down. And if the value of your shares will go down, then the acquirer will say that the company valuation is going down. I should not purchase such company. These are all the tactics which you can do if you want to prevent your company from the hostile takeover. Clear? Now, next is business alliances. So, what is business alliances? When companies are coming together, they are coming together with their expertise, with their resources, that is business alliances. Like joint ventures, strategic alliance, equity partnership. Okay, these are coming together with their expertise. Like the one is good in making the in production of the, let's take an example, manufacturing the car. Now, another company is good in manufacturing the components of car. This company is good in assembling the components of car, and this company is good in making the components of car. Now, these two companies have come together and they are working. That is business alliance. These are important. General Motors, Toyota formed a joint venture. Then Merck has 100 partners. IBM formed this. All the values are important. Now, 5 cents of acquisition is what? That is getting way too far away from it. Now, 5 cents of acquisition means you are acquiring the company, but that is not proved healthy for you. That has not proved good for you. Now, what are those five sins? Getting way too far away from it. You have gone such far that you cannot return back. You have got busy in acquisition so much that if you wish also, still you cannot return back. Striving for greatness means showing everybody that yes, see, I have acquired this company also, I have a lot of companies in my under. Plunging without thinking, that you have made the deal without thinking, without uh, thinking that company will give you high returns or not in future. Overpaying means value of company was 200 crore and you paid 250 crore for that. That is overpaying. And after acquisition, you are not able to take that company. You are not able to integrate well. Okay, you are not able to um, integrate with their employees. Okay, so that is what inability to integrate with, inability to do the performance in that company. Now, what are divestitures? Divestitures are what? Act of corporation selling one of its division or undertaking. Like this is the company, this whole company, when you are selling a part of this company, okay, when you are eliminating the part of this company, it is known as divestitures. Divestitures is the sale or disposal of the company's asset or business unit. So it can be done partial also, it can be done full also. Okay, it can be done through sale, exchange, and bankruptcy. Now, why this divestitures are important? Suppose this part is not making any kind of profit. Okay, the total income are insufficient. Okay, not sufficient. You're not making funds from this part of the company. That is why you have sold off. The focus on the most important aspect of the business. You want to focus on entire company. You cannot focus on entire company. You can focus only on 75% of the company. That is why you are laying that company off. Company might have, if you want immediate cash, for that reason you are paying the part, you are selling the part of your company so that you can get the immediate cash. So these are all the reasons for the diversity. Now we have different forms of divestitures. Okay, we'll do this slide in coming. Now, so holding company is what? That is the parent company, and parent company, the one who is having more than 50% of the shares, that will become what? The parent company. So in parent company, company A, B, C, subsidiary companies, 100% you have taken the control, that is only owned subsidiary. 75% you have taken the control, partially owned, and at least 50%. See, for any company to be a subsidiary, you should have taken at least 50% of that. Now, in divestitures, see, we have complete, or if you are selling complete, uh, the complete division of that company or the part of that company. Spin off in this scenario. Now, spin off, and there are two terms that is known as the split off. Now, what is spin off and what is split off? See, a part of the company becomes a separate new company. Suppose this is big company. Now, if you are selling the part of that company, that part of that company is becoming, this part is becoming entirely a new company. This is the parent company and this is becoming the entirely new company. The existing shareholders of the shares are given to whom? The existing shareholders of this parent company. They can take the shares in the newly formed company. That is spin off. Now, what is split off? Split off is what? That is a part of the company becomes a separate end company. Suppose this is the part, this part of the company is becoming the separate company. Only those shareholders who exchange their shares in the parent company. Only shares will be given to only those shareholders who are exchanging their shares of this parent company. They are taking the shares of the parent company and they are exchanging in this separate company. That is what? That is the split off. So this is what the spin off and the split off. So when you are distributing the part of your company, okay, you are making profit from that. You are selling the part of your company. Entirely new and separate independent companies formed from a parent company, and this is called a spin off. Split off, when a parent company is shut down and many different companies are formed, that is called split off. So this is the company. This company is shut down, the parent company, and three more companies are justice, that is split off. Yes. So split off is what? Only to those shareholders who exchange their shares of the parent company. Spin off, a new company is formed. Existing shareholders of the shares will be given to the existing shareholders of the parent company. Now, there is one term that is called split up. Now, split up is what? That is when this is the parent company. Now, this parent company is shut down and three more companies are formed from this. So, split up is three companies are forming from one parent company and the parent company is completely shut down. So, the entire company breaks into two or more new companies. Existing shareholder get the share in new companies. The original company stops existing. So this is split up and split off is what again see all these are the type of demerger also. These all are the type of demerger. So in the split off, when the shareholders have the opportunity to either they can keep shares of the parent company or they can get the share in the new formed company. So only those shareholders will be given who exchange their shares of the parent company. And spin-off where new independent entity is created from existing parent company where old shareholders they received shares in the new company. And one is equity carve out. Equity carve out is what? That is this in this okay the money is given by selling the share of the subsidiary company rather than the parent company. So subsidiary company is being sold. So small part of the business is made a new company. So like this is parent company. This parent company was having its subsidiary company. So small part of the business is made a subsidiary company to the new company. The shares to the new company are sold to public. So here shares are sold to whom? To public through IPO, not to the existing shareholders. So from parent company, a small part is made and it is created as new company and these new companies, the share of this new company are sold to general public through IPO, initial public offer, not given to shareholders. So this is all about the differences between the spin-off, split up, and equity carve-out. Here, now let's move to the next topic. See, LBO of Tetley. Now, LBO is what the full form of LBO is that is leveraged buyout. LBO is leveraged buyout. Leveraged buyout is what when you don't have full amount to buy the target company. So what you do in that case, you take the help of loan. You take debt from the bank, and from that debt you have to purchase the target company. Suppose this is acquirer and target. Now the cost of this target company is 100 crore. You have just 70 crore in your company. Now, what you will do in that case? In that case, you will take the loan of 30 crore and then you will purchase that company 100 crore. So this is known as leveraged buyout. Buying another company with the help of loan is called leveraged buyout. There is one case study on LB of Tetley, how LB of Tetley has done story of David and Goliath in the business world. The acquisition of Tetley Tea by Tata Tea generated quite a bit of publicity in the 2000s. So Tata Tea is an Indian company and the Tetley Tea was finally put up for sale. But at that time, this Tata Tea wanted to buy Tetley. The company net worth was only 114, but the acquisition cost was 450 million. Now, Tata Tea was not having that much money. So what the Tata Tea has done? The fact that this was the first acquisition made by Indian company contributed to this. So Tata company has taken the help from the bank and then that Tata company has purchased what? The debt. So Tata Tea is an Indian company. The negotiation for the acquisition began in February. Tata Tea was finally put up for sale. The takeover was remembered. Why? Because it was witnessed a global shock. But the value was high. So in that case, they have taken the help of loan, the Tata Tea company, and then the Tetley was acquired. Then next is Tata acquisition of Jaguar Land Rover. Yes. Now, in this case, what happened? Tata Motors, they have acquired what? Acquisition of Jaguar and Land Rover companies and worth rupees how much? The net consideration for the acquisition was $2.3 billion, which is equivalent to 9,400 crores. So these are the amount that you have to remember. Now, next chapter, that is deal financing. Now, what is this deal financing thing? When you have already analyzed that which company you have to buy, you have done the valuation, you have done the discounting, uh, you have done you have used various approaches for that. Now the final decision comes that how to close the deal. Okay, what is good for you? Either you are buying this company with full cash, or you are buying this company with shares, or you will going to purchase this company with the help of both shares and cash. That is the deal financing. So negotiation will be there both between the acquirer and the target company, between the borrower and purchaser. So an agreement between two parties specifying their rights and obligations is known as deal structure. Now, so different types of payment consideration is there, either in cash or in non-cash. In cash, do you want to purchase? In non-cash, do you want to purchase? Or mix of cash and stock both? Or in convertible securities, those securities which can be converted into debt later on. Clear? Now, so see, when doing the amalgamation, when doing mergers acquisition, so certain tax reliefs are given to them. Certain tax benefits are given to them in case of amalgamation in India. But given to whom? When the company is of Indian company. When the amalgamation is taking place in India, then only the tax relief and benefits will be provided. Now, if an amalgamation takes place within the meaning of the section 2 clause subsection 1B of the income tax, the following reliefs or benefits are provided to them. Now, what are the tax reliefs to the amalgamated company? Okay, exemption from capital gains will be given under section 47 subsection 6. Allotment of shares in amalgamated company to the shareholders of amalgamating company, section 47(2) and 49(2). Exemption from capital gains, as we have seen. Now, some tax relief are also given to the amalgamated company. Now, this tax relief is given. What tax relief is given? That is for carry forward and set off of accumulated loss and unabsorbed depreciation. This will come under section 72. Now, for this such type of relief, okay, the companies, they have to fulfill certain conditions. Then only they will be given such type of relief. So section 72A income tax 1961, it deals with the mergers of the SIC companies. Those companies who are not making profit, who are already in loss, okay, so merger of the SIC company to which company? To those companies who are making a lot of profit. That is healthy company. And to take advantage of the carry forward and accumulated loss. So I have told you earlier that why do these big and the profit making companies, they do the amalgamation of SIC companies or they merge with SIC companies just to get the benefit of tax advantage, okay, of carry forward and accumulated losses. But these conditions will only be you can say these benefits will only be given when the company has fulfilled certain conditions. Now, what are those conditions? First, there should be an amalgamation of company owning an industrial undertaking company should be there. One bank to another bank in section 5C with a specified bank. Public sector company who is engaged in the business of aircraft with one more public company, they can get the benefit. Or any specified bank means like State Bank of India under like the SBI and its associates. If all these such type of amalgamation is there, then The amalgamated company should be an Indian company. This should be the criteria. That company should have engaged for 3 years or more. And the new company, the one who has amalgamated the new company, it must keep at least 75% of their fixed asset of the previous company, at least 5 years. For at least how many years? 5 years. And the distressed company, okay, if you are taking distressed company, then what you have to do, you have to achieve the production level of this company at least 50%. You have to make this company such good that it can generate at least 50% of the installed capacity before the end of 4 years. And amalgamated company should have to provide, they should be given one electronic certificate in the form 62, and it has to be verified by accountant that yes, we are fulfilling all the conditions. Okay, once this condition has been fulfilled, then only they will get the benefit of accumulated losses, unabsorbed depreciation, and all. Okay, so these are all the conditions that has to be fulfilled. Then only this unabsorbed depreciation and carry forward benefit will be provided. Otherwise, not. So we have completed till here. Any doubt to anyone till now? And please, those who are watching, I highly request you to kindly subscribe our channel. Okay, do support our English medium channel, and if you feel session is helpful to you, then please like the session as well. Now, availability of MAT credit is given. Now, what is MAT? See, what happens? Many companies, they are very clever. What they do, okay, they know that we know that if income is high, okay, we have to pay more tax. If income is low, we have to pay less tax. So what these companies will do, these companies will show different types of expenses, okay, different types of you can say cost in the company, so to show less tax liability to the government. Okay, if they're making more profit, they will show less profit to the government so that they have to pay less tax to the government as. But here also government is also playing game. Government says that okay, you are clever, so I am more clever than you. So if you are paying, if you are showing me less tax, then what you have to do? You have to pay at least some minimum tax to me, and that minimum tax is called minimum alternate tax. It is included under which section? 115 JB of Indian Tax Act. And how much percent of profit is to be given? That is 15% of the company's book profit. In such case, the book profit computed are deemed to be the total income. So sometimes big companies, they show very low, zero profit, but they actually have what? The profits. Okay, so government say even if you show low profit, you must have to pay some minimum tax. This is called MAT, 15% of the book profit. Now, financing of cross-border acquisition. If any company is acquiring any other company, but that company is situated outside of India, then how to do the finance of cross-border acquisition? See, finance in cross-border acquisition is done in two ways. One is the inbound acquisition and one is the outbound acquisition. See, in next last chapter, there is one topic which is known as SPAC. SPAC is what? Special Purpose Acquisition Companies. Now, what is the work of these SPAC? These companies are made specifically just to acquire another company. For what? Just for the acquisition of another company. So similarly, for inbound and outbound acquisition, one FOCC is being incorporated. Now, first let's understand what is inbound and outbound. See, if an acquirer is its outsider, And the target company is what? Target company is an Indian company. If acquirer is outsider and target company is an Indian company, then it is known as inbound acquisition. For inbound acquisition, what happens? The company appoints the middleman in India, and that middleman acts as a foreign agent. And this foreign agent is called what? FOCC. That is foreign owned and controlled operating company. Why? Because the target company is Indian company, and any foreign company, foreign business, they want to purchase the target company. So for that, they will make one sort of company named as FOCC. Why? Because this company, if this company is situated in India, if this company is established in India, then it would be easy for them to acquire the Indian company. The company is following the guidelines of India, the rules of India, the regulation of India. So that is why one company, one middleman is being formed over here, who will do the work with respect to Indian company. Now, what is outbound acquisition? Like acquirer is of India, and that acquirer wants to acquire the foreign company. The target company is of foreign company. So it is known as outbound acquisition. Okay. So acquisition appoints and SPAC after this acquisition. So finance cannot be provided by Indian banks to acquisition for FOCC. So Indian bank will only provide finance to whom? To Indian company, not to those companies who are from outside. So they are not permitted to leverage in the Indian market. Who are not permitted? FOCC. This is what it is, just act as middleman of India, the foreign agent, okay, or the company just like SPAC. So foreign company wants to buy an Indian company. Instead of buying it directly, they create a new company in India, and that new company is called foreign owned controlled company. It is basically an Indian company but controlled by whom? Foreigners. So to acquire the Indian target company. Why this is done? To find the way, it is simpler way for foreign companies to buy Indian businesses while following the Indian law and regulation. It is easy to handle the permission and all taxes. Now, see, the Indian companies, they will not going to help the foreign companies for taking loan, for taking debt. Now, these foreign companies, they will get the benefit from where they can take the benefit, they can take the loan from LMA and APLMA in acquisition. So when companies take loan to buy another company, so this is known as what? They can take from Loan Market Association and from Asia Pacific Loan Market Association. Who can take? The foreign companies can. And if any Indian company want to acquire the foreign company, then definitely the Indian bank will help. Okay, this we have done. Now, so for outbound acquisition, okay, when Indian companies, if they want to buy foreign companies, the Indian company will help the companies to take loan from Indian bank. Okay, external commercial borrowing, Indian companies can take the foreign loans also to buy shares of different joint ventures of all the subsidiaries which are outside the India. So for Indian company, ECB and Indian bank will help. For foreign company, who will going to help? For foreign company, the LMA and India Pacific, what was APLMA will provide you. Now, so these are all the quick revision and summary is there. Now, let's start. We have completed our first module. That is first module of today's session. That is module numbers. Now, let's start with module D. That is hybrid finance. Now, what is hybrid finance? Hybrid means what? Combination of two elements. Now, what is the combination? Combination of equity plus combination of debt. So, hybrid finance is a type of hybrid securities which will give you two types of options. First, to get the benefit of debt, okay, to get the benefit of interest on debt, and later on, if you wish, you can convert your debt into equity. So, hybrid is what? Hybrid security is financial instrument which possess the characteristic of both debt and equity. So this will give the blend of both debt and equity. They can meet their specific investment needs. So types of these are all the types of hybrid securities. So let's do one by one. Now, preference capital we have already studied in our module B. So I am not going to repeat over here. Types of preference capital, you know, dividend will be given, liquidation, convertibility. We have all these types of preference shares. All this we have done in yesterday's class in module B. So if you want for the quick revision, you can watch that session. Now, next is what that is warrant. Now, what is warrant? Warrant is again a type of hybrid securities. Warrant gives the right. Remember, warrant gives the right. The right is there, but no obligation is there. Means if you wish, you can exercise these warrant in the market, but no mandatory. It is for you that you have to exercise. So it is the contractual agreement that gives what holder. And the one who is holding these warrant are known as warrant holder. Holder the right to buy or sell companies share at a set price at a specific price. So it will also give the benefit of equity as well as debt. Now, the holder the right is given but not the obligation to purchase a company stock at a specified price. This specified price is known as the exercise of strike price. Specified means the price which is mentioned over there at that time. Now, one model is there that is known as Black-Scholes model. Now, this model is used in case of derivatives. What risk your derivatives are having? Okay, how much risk? What is the fair price of your derivatives in the market? So, it is possible to assess the value of warrant by following the Black-Scholes model approach. Now, this Black-Scholes model is one of the most important concepts. It is based on the mathematical equation, also known as Black-Scholes-Merton model. Merton has given, okay, that is why it is known as Black and Merton has given, that is two names are combined to form Black-Scholes model. So Black-Scholes equation, it is a math formula that will help you to find that what your option, how much an option is really worth today. Means what is the value of your derivatives in the market today, like call option, put option, okay, future contract, forward contract. We have different derivatives. So for that, now this Black-Scholes model, okay, it helps to figure out the fair price of the call option, and it looks the five things. It has its five variables are there. Now, what is that? The stock price today. What is the stock worth right now? The strike price, at what price you can buy your stock in future. Okay, after how many times, okay, until your warrant expires, how long you can wait for that. Volatility, market is very volatile. Sometimes stock prices are going very high, sometimes stock prices are going very down. And risk-free interest rate, that is a safest return you can get from risk-free interest rate. And what is the risk-free interest rate? That is the government bond. Now, next we have perpetual non-cumulative preference shares, very important. So what is perpetual? Perpetual means which never comes to an end. Okay, irredeemable. They do not have the fixed maturity. Non-cumulative means what? The unpaid dividends, the area of dividends are not given to you. They are not accumulated in the present year. That is non-cumulative and preference shares. Now, so PNCPS is what? It is again an attractive option for investors looking for income without the risk of losing their investment due to non-payment of dividend. They carry risk of dividend. These are issued only to bank. Only bank can issue them. Now, PNCPS are what? The instruments should be issued only by bank. No other companies, no other any other regulatory bodies or corporations are allowed to issue. These are issued by the bank. Now, bank board will decide that how much PNCPS they can raise. Like if they want 10 lakh rupees, so they can raise PNCPS. And from PNCPS, okay, from tier 1, the how much value they can take from tier 1, that is 1.5% of RWA. So in addition, tier 1 capital cannot exceed 1.5 of RWA. If the remaining amount is left, they can take the help of from tier 2 capital. So once this minimum total tier 1 capital is met, any additional PNCPS can be issued by the bank. It can be added to tier 2 capital. Now, what is the limit of tier 2 capital? That it should be less than 2% of RWA. Tier 1 capital, it should be less than 1.5%. It cannot exceed 1.5%. It means in tier 1 capital, it can be 1.5%. It can be 1.4% also. It should not be more than that. But in tier 2 capital, it should always be less than 2%. Even if 2% is there, you will not going to consider this. It should be less than 2%. No maturity date is there. It is fixed or floating. Now, the example is given to you. Suppose risk weighted asset is 100 crore. Now, you have to allow the CPS. How much is allowed? It is 1.5% of RWA. So 1.5% of 100 crore. Now, if bank they have to issue 3 crore, so the rest of the 1.5 crore they can issue from this Tier 1 capital. Now, rest of the 1.5 crore they can take the help from Tier 2 capital, but it should be less than 2%. Yes, it should be less than 2%. Now, so this PNCPS should not have put option. They only have call option. They wish they can call the public and they can give their shares back, but public are not allowed to come and ask their shares from the bank. That is it. Do not have put option. They only have call option. And the call option will be only given when the instrument is accepted and it has worked for at least 5 years, it has run for at least 5 years, and RBI guidelines are mandatory. They have to take the permission from RBI. Principle of instrument may be repeat only with the prior approval, and the financial institutional investors and NRI may invest up to 49 and 24%. This is the total. This is the total. But for each investor, for one single FII, 10% is given, one single NRI, 5% is given. And banks, they are not allowed to issue any kind of advance against PNCPs. Now, foreign currency convertible bonds these are issued, okay, in currency different from the issuer currency. Like if issuer is of India, now it is issued in any foreign currency. If issuer is in any the foreign country, they can issue from Indian country. So these bonds are issued in a currency different from the issuer's home currency. So they have regular interest payment. See, bonds, debentures, these are what these will be get the benefit of interest. Till the time you want to enjoy the benefit of interest, you will enjoy. After that, if you wish, you can convert those bonds, debentures into equity shares. So holder have the option to convert bonds into companies. Now, company stock price is lower than the conversion price. Conversion date, bondholder will not going to convert their bonds into shares. But if the company stock price is lower than the conversion price, means conversion price is high and the stock price is low. So if they have to convert it into the stocks of the company, then they have to pay more price. Why? Because the conversion price is high. That is why it is not the good option for them. Now, risk is exchange rate risk will be there, credit risk will be there, and typical maturity period is for how many years? 5 years. This is all about your FCCBs. Now, convertible debentures, similarly, those debentures which can be converted into equity shares later on, these are convertible. Loan are there, convertibility is there, and they get interest payment. Now, what are the features of CD? So these are the features of CD. It is see, convertible debentures. They are two options. One is automatic convertible debentures are there, and one is the convertible given with options. Convertible is given with option. And what are two options? That is the call option and the again what is the put option. Two options are given. First is automatic convertible. Next, if convertible is there, then two options are given. Put option and call option. Now, if the conversion takes place at or after 18 months from the date of allotment, but before 36 months, if the conversion duration is made optional with put and call, and it is longer than 13 months, it will not be approved. And if it is conversion time is longer than 18 months, then the credit rating is required. See, what the question, what this is, if the time period is less than 18 months, no conversion is allowed. Okay, time period of what? Of debentures. Now, Second is what? If the time period is more than 18 months but less than 36 months. It is allowed. Third is what? If conversion time period is more than 36 months, conversion is allowed. But two options are attached with it. What is the put option and the call option? So remember, in debentures, put and call, both options are given. But in PNCPS, only call option is given. See, no put option is given, only call option is given. Here, the company can also call and the investors can also go for the ask of their shares. Now, conversion ratio and conversion price is given. Now, conversion ratio and conversion price is what? It is related to convertible securities. Conversion ratio, number of common shares a bondholder will receive when they will convert their security. So, how conversion ratio is calculated? It is calculated by dividing the convertible securities par value or face value upon conversion price. So if you will be asked to find the conversion price, you can find with the help of these two. If you learn one formula, you can find three different ways. Now, so example, conversion ratio of 20:1 means that one bond will be converted into 20 shares. And at what price you are converting, that is called the conversion price. The price at which convertible bonds can be converted into shares. Now, next is mezzanine finance. Again, very important. So this is again a type of hybrid security. The mezzanine finance, the one can get the benefit of mezzanine finance only when they have done the default. Okay. Now, mezzanine finance is crucial component of corporate financing that sits between traditional debt and equity. Suppose the company has taken the loan, okay, from any different company. Now, if that company has done the default, if that company could not repay the money back, now in that case, uh, what the offer the lender will give, the lender will give the right, the lender the gives it gives the right the lender that they can convert their debt into equity. If you have done the default, when the repayment date comes, you have taken the loan of 50 lakh rupees, okay, from XYZ company, but you could not refund that 50 lakh rupees on the repayment date. Now, what that company is offering you, company is saying you have done the default. Now, I'm giving you option that, okay, you don't have sufficient money to repay my money back. You can become my equity shareholders. You can convert your debt into equity. Now, why the company will do such kind of act? See, two benefits are there. The first, already they have done the default, so they cannot ask for the more ownership like the other equity shareholders. They are getting the ownership, the more ownership they cannot ask. This is the first benefit. And second, if they are having more equity shares, then the value of the company will increase. So if the value of the company will increase, the value in the market will also increase. That is why. So this is another hybrid type of debt and equity financing that gives the lender the right to convert debt into equity in case if they have done any kind of default. These finance provide higher returns. It is unsecured and it matures more than 5 years. Done. So module C is over and module D first unit is over. So let's have a break for 10 minutes and then we'll proceed with after 10 minutes. Okay. So let's meet you after 10 minutes. Please confirm me my audibility. My audibility. Yes, I'm audible. Chal. So we have completed unit number 19. Now, next unit is unit number 20. This unit is all about your startup. So startup is a type of newly established business who have like this business should have different kind of business model. A scalable business should be there, often characterized with their innovation, scalability, and potential for rapid growth. Then they usually these type of startup business, they usually work on the solution of any problem, finding solutions to any problem. This is important. They rely funding from venture capital. Under DPIIT, Startup India was established, and this department is important for startup. The Startup India Hub is an online portal that offers different variety for Startup India, and this portal was launched in April 16, whereas Startup India initiative was launched in January 16. Now, what are the benefits for the startup? If any startup is there, what benefits government provide? That support they give, tax intensive, capital gain tax exemptions, then 3 to 5 exclusion from any business. No inspection will be that there in any business from 3 to 5 years. If business is filing for patent registration, 80% discount, 50% rebate on trademark. Important. The Atal Mission and Self-Employment Setu program has developed this Setu and Atal Mission program to encourage innovations. Then Startup India definition. So we have initial and expanded definition. Initial definition, 5 years, the company should have worked from the date of its incorporation. It should not have exceed its turnover more than 25 crore, and that company should have worked towards innovation and development. So this was the initial. Now 5 years turn changed to 10 years in expanded, 25 crore changed to 100 crore. We have different programs. Now, what is incubator grant challenge? Different programs are there, competitions are there that government will provide under different schemes. Okay, so that these startups may grow more and they may do more and more business. So, who are incubators? Incubator is a person who is technically sound and financially sound. As a part of Atal Innovation Mission established, Atal Innovation Mission has established incubator centers, and these incubator centers will provide the technical support also and financial support also. Now, to date, 54.65 crore has been distributed. Startup India Yatra, this Yatra program with the intention of traveling different cities from finding the talented entrepreneurs in Tier 2 and Tier 3. IBC code 16, if any startup has not run well, then for winding up their activity, 90 days is given rather than 180 days. Rest of the company, 180 days, 90 days. Full form of Inspire is important. Women Development Program support, it supports women. Okay, fund is provided from SEBI organization. GEM, Government E-Market is there. Online platform where government departments buy products and services. It helps these startups get big government buyers. Government will buy from them. Innovation zones are there. Any innovative product is there, then these zones are created so to showcase their product, their innovation. If any state is having high number of startups, they will be ranked first. Startup India Showcase launch date is important. Digital Demo Day, it works on the digitization, the virtual reality, augmented reality. Any product related to animal husbandry, then they will become under this program scheme. Ayushman Pradhan Mantri Jan Arogya Yojana related to medicines, pharmaceuticals, textile, and this is renewable resources, Ministry of New and Renewable Resources. Now, Digital Demo Day is conference and display for new technologies who are just getting started in Germany. So this program started in Germany, and if any startups are there which is related to digitization, the augmented reality, Internet of Things, virtual things, smart drive devices, drones, and all this will be included under Digital Demo Day. So demo will be provided okay, related to these components. Now, research park. So as of May 2021, we were having only 8 research park, but now as of year 2025, total 9 research park is there. One IIT Madras is added. Now, tax exemptions are given. Section 56, subsection 2, clause 7b, all are important. Tax exemptions are given. Subscription of those shares which is held company at a value that is higher than the fair market value, then what tax exemption will be given under section 56, subsection 2. So startups have been granted an exemption from income tax when the issue of shares of a price is higher than the fair market value. 80 IAC, so turnover 100% taxation, we can say the relaxation will be given, has been increased to 100 crore from the limit of 25 crore. Those startup which has come to the expanded definition. Now, so these startups, they can take the benefit of, okay, the 3 consecutive years out of 10 years. So these startups, they will not be given any type of any kind of tax. Okay, 3 consecutive years will be. So it might be 1, 2, 3, 3, 4, 5, 4, 5, 6, 5, 6, 7, but it should be out of 10 years. Any Hindu undivided family is there, then they will be excused from paying tax on capital gain covered under section 54GB. And ESOPs are what? A benefit is given to the employees so that they do not have to pay double taxation. It allows them to buy shares of the company at pre-decided price. So they are subject to double taxation, and it gives the delay that you can pay your taxes after 5 years. Okay, so for 5 years, the tax delay is given to them. So they are exempt for up to a period of 5 years. Clear? Next is funding. So yes, for Startup India programs, we need funding. We need funding. The initial level, we need funding. At seed level, we need funding, and high level also. Now, who will provide the funding? The angel investors and venture capitalists. So it is essential to provide seed funding to startups with an innovative idea, and they can take the help from which scheme? Startup India Seed Fund Scheme. So for that, they have to show that they have to give the proof of concept. They have to show that their product is in the prototype, or their product is in the product trials, in pilot testing, or in commercialization. Then only they will get the assistance from Startup India Seed Fund Scheme. That is SISF. Now, so who can apply for this scheme? First is that startup should be the recognized startup, officially recognized by DPIIT. The company should not be older than 2 years. That startup should have good idea on how to invent any product. Working on that product solves a real problem, has high potential growth. Technology should be involved, a good and latest technology should be there. They should have worked in all these fields, startups working in important sectors like all this social impact, waste management, education, healthcare. Funding limit, that is, the startup must have not received more than 10 lakh from any central or state government. Okay. So exceptions are what? The prize money subsidized are not included in this. Do not count in this 10 lakh limit. So if they have received more than 10 lakhs, so it will not be counted over here. So startup must not have received more than 10 lakh from any central or state government schemes. Yes, rewards can be counted, prize money can be counted, but not this amount. Ownership condition, 51% of the company's shares must be owned by the enterprise, the Indian promoters. And in short, we have the summary. This is the summary in short. Now, who can apply? Okay, for incubators. Now, incubators can apply for this, but what certain conditions the incubators have to fulfill? That the entity must be proper legal entity, either a society, trust, company, or statutory body. That entity should have run for at least 2 years. The incubator should have space for at least 25 people. They can cater 25 people. That incubator must have worked at least in 5 different startups before this. Experienced skill should be there. Leadership quality should be there. Full-time CEO should be there. Managing funds, legal matters, no private funds. The incubator cannot take money from the third party to help the startup companies. The incubator cannot use private fund to give seed funding. They can use their own money also and always get the government support, like funding, land, or infrastructure. Now, so we have different stages of startup and sources of fund. Idea phase is what? When you have an idea in your mind that you will going to develop this product. Okay. You have not put that product into action, but just you have idea in your mind. Now, in that case, you can arrange the funds from bootstrapping. Bootstrapping is what? Your savings or reserves and surplus. Seed stage is what? When your product is ready for testing, when your product is ready for the trials. Okay. So angel investors and private individuals, they put their money into high potential enterprises. And at seed stage, you can raise funds through a method known as crowdfunding. Crowdfunding is what? If you are taking help from family, from relatives, from peer members, from different persons, that is crowdfunding. Now, angel investors are private individuals that put money into high potential enterprises. They can give money as series stage funding. Scaling means series B, series C stage. Company can develop. The funding comes from venture capital. Scaling late stage firms comes from venture capital that have larger ticket size. So venture capital will invest only in those business who have the potential to grow. And after that, they will take the exit form. So this is the summary for, okay. Now, yes, this is the summary. Now, what are the schemes? Okay, under this we have different schemes. Fund of fund schemes. The fund size is 10,000. What is the purpose? To increase startup who gets the money? Venture capital funds. Now, venture capital will get the money and they will use that money in the startup. Not directly the startup will get this amount. Credit guarantee scheme. What is the purpose? 500 crore per year. Bank will give to the startup and startups will give to the incubators. That is not 945 crore for seed funds. Next chapter is what? That is of venture capital and private equity. Now, venture capital and private equity are the two types of capital who provide funds in your early stage of business. They will enter into your business. They will help you in your business to grow. They will ask a huge ownership from your business when they will when they will invest in your business. And after that, when they have worked, when they have, you can say, when they have generated huge profit in your business, at last, what they will do, they will sell a part of that business or they will sell the shares to another company and they will take the exit mode. So this is how the venture capitalists, they work in different companies. Type of private equity financing that is provided to early stage, high potential startups. Now, so VC involves investment made by firms, individuals into startup for exchange of equity. Now, what their goal is? Their goal is to make the company grow. Their goal is to earn high returns from the company. High returns from the companies. They invest in companies as investors. So key component of venture capital, they invest in seed funding when the product is at their idea stage, early stage when the product is at their initial stage, the prototype, and growth when they want their product to expand further into new markets. So these are the investment stages. Now sourcing deal, they will provide the funds through different networks, incubators. Negotiation will be, and how they will take the exit mode? By IPO through acquisition, or they will sell their shares to another company, to another investors. If they feel that they cannot be the part of this company, so they can sell their shares to other investors, and that investor will work on behalf of that venture capitalist. And this is what the secondary sale. Now, so we have financing option available through venture capital. First, venture capital will provide the finance at the initial stage of development, in the seed stage, in the funding stage, okay, in the scaling stage. Then they will provide the finance for expansion. If you want your product to expand, if you want your company to expand, they will provide funds in that case. And if you want to acquire any other company, in that case also the venture capitalist will provide you finance. So these are Indian venture capital firms. Okay, some Indian venture capital firms are there. So these all are important. The Bloom Ventures, it is a venture firm that was established in 2010. They presently have invested in over 150 startups. Then Kalari Capital, important. These have venture capitalists have invested in seed and Series A startup, then Nexus Vector Fund. Now, what are the future of VCs in future? First, how they work in the companies. So first, they will arrange capital for you. After that, they will invest in your company. They will take the part of the ownership of your company and they will invest in your company. Then they will help the company to grow. And finally, when the company has grown, when company has maintained, company has generated higher profits, then they will take the exit route. So this is how they work in every company. Now, private equity is what private equity, they invest in only those companies which are private. Okay, they do not invest private equity holders. The private equity ones, they will not invest in those companies which are public. So they invest in private companies. Private funds invest in to a privately held companies which are not yet public. Now, what are the investment in private company? The venture capital invest in early stages startup, then growth equity. They will provide funds if the business wants to expand its operation to different countries or different regions. Then buyout means what? When one party acquires control of the company, and that party should acquire the control at least 51%. It should be more than 50%, but it should not be less than 50%. And distressed assets, that is, they will join the company, they will help the company, they will make their assets to grow, uh, give, they will there is obligation of liabilities, they will try to reduce this obligation, and in such way they will help the companies who are troubled companies and provide potential to grow. Now, this is important. Why do limited partners own 99% and have limited liability? See, limited partners are those partners whose liabilities are limited. Okay, so limited partners are any investors. They provide majority of the money to for the private equity firm. Now, they just invest in their money and they expect a huge return from that money. They will not work anything extra. They just provide the money. So 99% ownership is what they provide almost all the capital. So they get almost all the ownership. Now, but general partners, they own only 1% and have full liability. Why? Because they are giving less money in the company, but they are more actively, they are busy in making decisions, okay, choosing investment wisely, running the funds. So they don't put much of their money, they mainly contribute skills and efforts. So this is why that is why it is 1%. They have full liability. But on the other hand, they have 99%, they own 99% and they have limited liability. Clear? So limited partners, they are not running the business. So if anything goes wrong in the business, they are not liable for it. Who are liable for it? The general partners are liable for it. And what is the maximum loss for limited partners? The maximum loss is the only money they have invested. If they have invested 10 crore rupees in the company, so this is the only money which they will lose, not beyond this. Rest of the amount the general partners have to bear. Now, what is LBO? Just now we have studied that buying the company with the help of loan, that is LBO, taking debt to buy the company. Now, angel funds are what? Angel funds, it comes under the subcategory of category 1 alternative investment fund. So alternative investment funds, we have three categories: category 1, category 2, and category 3. So category 1 is very basic category, then more risky category 2, and highest risky the category 3 is. In case of angel fund, a, see, angel investors will provide what? Angel funds. So alternative investment fund is what? It is the type of investment fund where people pool their money together to invest in things other than stock. So we have all different alternatives are there. Like, see, in alternative investment fund, what have that you are not keeping money at one place. That money is being distributed, diversified, so that you can enjoy the benefit of different areas. So these are alternative because they invest in different other areas like private equity, we have venture capitalists, hedge, infrastructure, all these things. So if those investment will grow, you will earn all profits from them. If the project fail, you could lose money. So category one, we have startup, small business, social ventures. It is medium risk. Category two, we have private equity, debt funds, real estate, medium, and this is high. The hedge funds and complex trading strategies. So this is all about. So SEBI Alternate Investment Fund Regulation. SEBI of India introduced the SEBI Alternate Investment Fund with the goal of increasing accountability and MAT stability. So in category 1 AIF, we have all this in category 2 and category 3. So category 1 is very, very important. So just for better understanding, category 1, we have venture capital, infrastructure, angel fund, social venture. In category 2, investment related to equity and debt security. So all these will be included in category 2. The private equity funds, debt funds, and fund of funds. And most risky is what? The category. This is what the most risky, the hedge funds, the fund. Now, these are the exit strategy. How venture capitalists, they will take the exit mode with the help of initial public offering. The shares are offered to the public. They will offer their shares to the public for the first time on the stock exchange. Then trade skill. The private equity fund, they sell their stake to another company in the same or related industry. And secondary buyout is they will sell their stake to another private equity firm. Doesn't matter in the same business or unrelated business. To track that at the same time, this private equity will take the benefit of IPO also. They will prepare for IPO also, and they will prepare themselves for the trade sale also at the same time. And recapitalization is that is taking more capital, means enhancing the capital, recapitalization. So taking loan for paying your dividends to your private equity investors because they are the investors, they are the shareholders. So they also want dividend from your company. If you are not having the that funds to pay dividend to your private equity, then what you will do? You will take the help of recapitalization through use of leverage. You will take big loan to use that money to pay dividends. Now, financial due diligence is following all the compliances. Okay, investor due diligence is process of analyzing and assessing that in any investment which is done or the decision is taken very wisely. Informed decisions are taken, reliable information and accurate decisions are taken, and all has to be followed with the proper guidelines and compliances so that less risk will be there. Now, so we have completed the startup finance. Now, next is what? Next chapter is AI. So AI is what? Artificial intelligence. Again, 3 to 4 marks of questions you will be seeing from this chapter AI. Now, AI is what? It is the replication of human intelligence into machines. Okay, that is what artificial intelligence. Ability of computers or machines to perform tasks that the person can do, that human people can do. Like if we can think, we can write anything. So you are making such models, you are inventing such type of tools and techniques that the human thought can be used in that model, can be used in that machines, like robotics. So in human, we have machine learning, okay, machine learning, deep learning, neural networks. In artificial learning, machine learning is the using different tools and techniques in AI, that is machine learning. Deep learning, the permanent learning, and neural networks are what? That is the neurons, nodes are attached, okay, circuits are attached, so to provide the train that model, and with that neural, just like brain, neural networks are what? Just your brains are working. Like if I touch you, you will get any kind of sensation, your brain will react. Similarly, these neural networks are what? These are the nodes or circuits, these are attached into the AI tools like in any robot or any other gadgets, and when the model is being trained, that model is being applied in that neural networks. So history of AI, Alan Turing is what? Mathematician, United Kingdom, who said that the machine is intelligent. Whereas who has coined the term artificial intelligence? John McCarthy, a professor, they have coined the term mathematical artificial intelligence. Now, applicability of AI, it is used in healthcare, it is used in finance, retail, manufacturing, transportation, education, entertainment, NLP, smart cities, R&D, everywhere the AI is used. Now, what Google have contributed in AI? So, Google have contributed major effect. First is research and development. So, this Google, if you have seen the Google Assistant in the Chrome or Google, you have seen the search bar. In that search bar, the mic is there. Okay, now if you will ask anything, okay, that mic will respond what you are saying. That mic will the audibility, the audio will give you the answers. Like if you are searching for the images of, like let's take images of 2 BHK flat. Now that will, if you are giving this input, that is working inside its model. Okay, after that the output is provided to you with the different images with different videos. So this is the Google which have contributed in the field of AI. Okay, NLP is their natural language processing. So what you can read, you can write. So simply the machines, they can also read, they can also write. Okay, you are training them, you are providing them the exact the thing which you want to search. Like if you are searching the same thing, that Google will search for you. That is natural language processing. Okay, helping the machines, helping intelligent machines to understand, to read, to write in the same way, the way which you are doing. Like Google Assistant, we have image and video analytics, we have. Now, NLP is what? It is the technology that help computers to understand, work with human language. Like we have chatbots. Okay, simply if you chatbots are there, if you write anything on this chat, it will simply give you the answers. Okay, or it is 24 into 7 available. So these chatbots are used basically in industries, basically in offices, big companies. These chatbots are used. So it is used on the website. So anytime, anywhere you can access, you can take the help of these chatbots. Like voice assistant, the Siri or Alexa, if you will ask anything, if you will say, Alexa, turn on the lights. So what Alexa will do? Alexa will turn on the lights of your room, of your office. So that is what you are giving them the trainings, and that training is permanent. That permanent training is called, that permanent learning is called deep learning. So you can read, write, listen, and speak. Now, search engine Google rank. So the adoption of Google's rank to brain, it was what? A search engine algorithm, and it was officially confirmed on 26th October. So AI hub is there, the collection of all the things, the collection of um, different tools, okay, incubators, research centers. These can be physical location, research centers or tech incubators, and community support for AI practitioners. They often include resources what? Access to data sets, software and tools for AI, then for networking, for education, collaboration, and for innovation. So AI Hub is what? It is the collaboration of all the AI tools at one place so that you can use and they can share, they can help each other. Now, Flow pipeline is what? It is Flow pipeline is, it is the systematic step-by-step process. It will help you to automate all the tasks. It provides training, it provides testing, and it will deploy our AI model. Like for example, it is the tool designed to help you build and manage workflows. Like if I say that in AI projects, you have certain steps. Okay. If you want to bake a cake, the following steps are there. First, you will prepare, you will data preparation is there, then model training, then model testing, and last is you will finally deploy that model. You will check the result that whether actually it is working or not. So Cube and Kubeflow comes from Kubernetes, a platform that helps manage and run these workflows. Now, AI is used in banking also, like chatbot, it helps customers, robotic advices, it gives advices on credit scores, predictive analytics, making predictions for the future outcomes, scoring card, or you can see the credit scoring. It helps in credit scoring. Analytics, process of using data to forecast future outcomes. Now, AI and morality, that we are using AI, we should keep in mind that we have to use the artificial intelligence, we have to use AI tools and technologies in a proper, in a ethics. So ethically, it should be correct. It should not harm our society. So ethical consideration, that is decision making, proper decision making can be taken with the help of AI, from healthcare to criminal bias and fairness. That is, if you are providing the wrong data, the biased data, then how you are expecting the correct data. So AI system can perpetuate to amplify existing biases. Autonomy is their independence is there. AI can take their own decisions. Privacy, you have to maintain the privacy. There is technology. So there is the biggest demerit of technology is that the privacy. Your data may leak. Okay, your system may have. You can get the fraudulent spam messages, calls. This. So privacy has to be maintained. And job displacement, that with the intervention of AI, with the intervention of new technologies, what has happened? The jobs have been very less in the country because everything is getting automated. There is no more paperwork. There is no more manual work. Everything is happening on the computer, on the system. So now AI can lead to job losses, and it's a responsibility of the companies and government to support those displaced workers who have lost their job with, in case of with respect to AI. Okay, done. So we have completed AI now. Next topic is what, that is business analytics as management tool. Now, what is business analytics as management tool? We know that we have studied AI. We know that how much data are required in the company. If the company is big, definitely the data is also big. If company is small, they have limited data. So business analytics helps what, it is the combination of the human skills, the technical skills, the technologies, and practices that are used to analyze the data. Okay, so who will analyze? Again, the human will analyze. So they should have the proper skill to use the technology and performance of the organization. So there are two terms, data mining and text mining. Now, data mining is what, when you are using useful data from multiple different data, like a lot of data is there, and you are extracting useful data for your business, extracting useful data for your business, that is called data mining. So the first conference was held on knowledge, discovery, and data. It was held in Montreal. This is important. And the phrase data mining was given. Now, which association has hosted this conference? The RE, the Association for the Advancement of Artificial Intelligence. This is important. And for subsequent 3 years. Now, in business analytics, for analyzing the business, the outcome, the result, the data, there are different types of business analytics. 4 types of business analytics are there. Descriptive analytics, it gives you the answer what has happened. Okay, what will happen, what has happened. That not will, what has happened in past, the historical data. Diagnostic, what was the reason that it happened. It explains why it happened. Predictive, it will tell you that in future what will happen. Okay, it will help you to analyze your future outcomes, that making predictions, making forecasting. And prescriptive, it tells you that by analyzing your previous data, the prescriptive analytics will tell you that what, how it can happen, how it can happen. This is what the prescriptive analytics makes use of data on previous performance to make recommendations how similar situation should be managed. So what happened, what will happen, and how we can make it happen. Clear? That is prescriptive. What we can do that this thing will happen. Okay, what happened? What happened in past? Why it happened? Diagnostic. Okay, what will happen in future? That is predictive. And how we can make it happen? That is prescriptive. So it gives the answer what, it gives the answer why, it gives the answer what will, what has happened, and it gives the answer how we can make it happen. Now, so elements of business analytics, different elements are there. Data mining, we have already done. Okay, now text mining, extracting useful text from the number of text, that is text mining. Now, data aggregation is what, that is combination. Okay, combination of what? Combining data. Data aggregation means combining data from different sources to make one proper data, to make one big picture. Like if you are combining weekly sales, monthly sales, okay, If you are combining weekly sales, then monthly sales will be there. If you will combine your monthly sales, you will get your weekly sales. So this is what the data aggregation. And in data aggregation, two types of aggregation is done: the time and spatial. Time talks about the time and spatial talks about the location. Like it means combining data over a period of time. Okay, monthly sales, average temperature per day, and spatial aggregation into combining data from different locations. Okay, like if I combine data that how many women are literate in your area, okay, in your region. Now, in A region, in B region, in C region, and in D region, how many women are literate? If you will combine all the region together, that you will be getting what that district. Okay, if you will combine all the district, you will be getting the numbers of states. So this is what time and space. So data over time and data over places. Now, data mining process is what first you will collect the data. After collecting the data, you will prepare the data that these are important for your business. Okay. Once you have prepared the data, then you will in that data what activity what data is required, you will do the data mining process. That see different activities are there in our company related to finance, related to operations, related to marketing, related to human resource. Now you know that these data are available in your company. Now for finance department, you have to extract useful data for finance. Those data which are related to finance, you will extract that data. That is data mining process. And after that, you will analyze, you will interpret the result that the data which you have used for your work, for your task, for your activity, that data is good or not. Okay, that data is helpful to you or not. That is data mining process. So certain software and tools are there in data mining. So these are all the software tools and techniques. Entrelix, AWS, Databricks, the CAIIB, then Data Robot, Google, H2O. So these are Oracle, Rapid Miner software and techniques which will help you in doing the data mining, extracting useful data from a lot of data, that is data mining. Now, next, similarly, data mining, we have seen text mining also, extracting the useful text from different sort of text, different paragraphs. That is what the text mining is. And what is the work of text mining? Process of converting your unstructured text into the structured format. Now, unstructured and structured format is what? Like if you are getting the text in, you can say in doc, okay, word in doc. Or if you are getting like videos in like WMV or MP4 or the audio files in MP3. Now, if you are getting in this way, so this is what this is the unstructured data, unstructured text. Now you are converting that unstructured into the structured form of text. Okay, like doc, you are converting in the PDF in the proper words. The WMV files, you are converting that into the proper movie, proper the playing video. MP4 the video, the MP3 the proper song. So that is what you are converting your structured into unstructured into the structured format. So structured data, what we have, this data has been standardized into tabular format, like it consists of several rows and columns. Suppose this is rows and columns. Now on this rows and columns, the name of the person, okay, the name of the person is written A, B, C, D, E. Now we will write its address, the name of that person's address, then phone number, okay, then alternate number, then at what time that person report in the office. So this is what this is the format of structured data. Unstructured format, video and audio, and semi-structured is what? A mixture of structured and unstructured. Now, text mining techniques, we have that retrieval of information. Retrieval means how much you can get back that information. The following are the retrieval of information is there, that is tokenization. Tokenization refers to that a long paragraph is given, and in long paragraph, you are framing that paragraph one statement or in proper individual sentences in individual lines, so that it may be easy for the company also and for its the outsider members or their employees also to read that to read that document properly. So text into individual sentences and words like in sentence from one lengthy paragraph. Stemming is what? That is removing the suffix and prefix. Prefix is the before, like if I say Mr. X. So this is what? Removing Mr. from X prefix. And if I say like X ma'am or Y sir. So if you are removing the sir and ma'am, that is what? That is the suffix. So removing prefix and suffix, so to make the data more authentic and more reliable. Now, natural language processing, we have already done, making computers understand the human language. Now, what language the computer understand? Computer understand 0 and 1 language. The 0 and 1 is what? The bits. Okay, the bytes. 0 and 1 is the byte. And the machine language is converted into the object code, and that object code is what? The code which you understand. Means the Hindi, English, or any other language. So in NLP, the summarization is there, like making long text short by keeping the main points. Then tagging is there, so you know that which word is giving which meaning. If I write the name, let's take an example, Ramesh. So Ramesh is what? It is the noun. You can easily understand. Okay. So this is what you can easily find, that which is noun, which is pronoun, which is verb, which is adverb. You are making the category, okay, similar type of categories you are making, and sentiment analysis, that see if any document is there, if any messages is there, any text is there. Now you can understand the one who is reading that text, from that sentiment, from that person's sentiment, you can understand what is written in this text. Then next, extraction of information. So different information you can extract from big text of data. Then time intervals from data collection and aggregation. So time frame for reports are there. Specific period are given. Granularity is there. Granularity means how detailed the data is. If the data is very detailed, means high granularity is there. Okay, you can find the, like in any store, what in 1 minute, in 1 hour, okay, in 1 day, what is happening. So if you are finding the detailed version of that company, detailed data of that company, so it is high granularity. Low granularity means like no data. You are finding the data of 1 month. You are finding the data of 5 months, 4 months. That is low granularity. So it can range anywhere from 1 minute to 1 month. Now, forecasting is what? Making predictions for future forecasting. So we have qualitative and quantitative technique. Qualitative, it is what? It is subjective. And quantitative is what? Where numbers are involved. Now, why there is need for the forecasting, for making prediction, to analyze that in coming scenario, what will going to happen? Okay, what are the things that will affect your company? What are the factors that will create disturbances in your company? That is why the forecasting and predictions are important. Clear? Now, so forecasting, long term is there, like for 5 years or more than that, long term forecast is there. Now, for medium term forecasting is what? If you are making predictions from 1 season to 2 years, and short term is what? 1 day to 1 year. That is less than 1 year. Now, next is what? That is data visualization. So data visualization is what? If you will show data, okay, in the form of infographics, in the form of diagrammatically, in the form of charts, in the form of pie chart, in the form of different histogram, bar graph, then it will be more clear for the person to understand that data. And if you are just simply saying that this is the Mr. X customer is having this data, Mr. Y customer was having this data, so it will become quite difficult for them to understand. So data visualization is what? Process of representing data through the use of popular graphics such as charts, plots, and infographics. Infographic is what? Information plus graph. Now, different visualization tables with the help of rows and columns. Pie chart. Now, what is this? This is what? This is your pie chart. Suppose this is 50%, this is 30%, this is 20%. So this is pie chart, then histogram, starter, heat map. So you will see that this is heat map. These red dots are what? These are heat maps. These will tell you that how much dense the thing is. So here we have, here in this image, the red is taken as the dense. Okay, so these are the example of heat maps. Now, big data analytics, again, big data analytics means if data is huge, data size is large, um, you need to protect that data. Okay, you need to keep that data in the proper database so that whenever you want, you can access that data in the timely manner. So big data is a term that refers to data sets that are so large or complex that typical relational database are unable to effectively record. So for that, you have to make those databases which can record your huge amount of data. Okay, data will, it may vary from bits to bits, then we have bytes, then we have kilobytes, then we have megabytes, then we have gigabytes, then terabytes, then petabytes. So all these are what? These are the size of the data that, and if the data is large, data is having large size, so you need to place them in a different type of databases. You have to make big databases so that you can record all your data of your company. Now, so use of big data analytics, it enhances the integration of customers. Okay, it motivates them. Like if customers are coming to you, they are asking any kind of data, they are asking any kind of information, how you will provide the information to them? If you will be if you are having the proper data related to that particular activity, that particular topic, then only you will going to provide them. Na? So if you will provide the data, every type of information to your customers, so they will feel motivated, frauds will be less, and efficiency will be high. Now, these are all the following six industries where big data analytics are used, and all are important: manufacturing, retail, healthcare, oil and gas, telecommunication, and financial services. Now, how does big data analytics work? First, collection of data is important. You will collect the data from different sources, primary sources, secondary sources. Okay, then you will process that data, you will train that data, you will process into the action, then data cleaning is done, that is again data mining, and at last you will analyze your data. Now, big data analytics tools and technology. So big data analytics tools and technology are what? See, there are different tools and technologies that are used in big data analytics. The first is Hadoop. Hadoop is what? It is an open source system. It is free for all. The big storage devices, the big data can be stored under this Hadoop. MapReduce is key component for Hadoop software. Now, full form of Yarn is important. Spark is just like your open source software. And Tableau is what? A platform for end-to-end data from where you can derive large amount of data. So this is open source software maintained through collaboration. So this open source software is what? It is free to use. Yes, it is available for anyone to use. That person can modify also, that person can do the changes also. Like Android, we have Ubuntu, we have Java, then MySQL, structured query language, Apache, all these. So Hadoop is what? It is a framework that helps store and process large amount of data called big data. So it handles huge data easily, it stores data safely, cost effective as well. Yeah. So we have completed our this topic, that is business analytics and big data analytics. Okay, just wait for 1 minute. Let me have water. Now, next is what that is green financing. Okay, green and sustainable financing. So, what is green financing? Green financing means raising money for projects to help protect environment. You are raising money from those. Okay, you are raising money for the projects. You are investing in those projects that will help your environment, that will keep your environment safe, that will help in combating any kind of climate change. So examples of green tools are green bonds are there, loans are there, then green mutual funds are there. Green bonds, bonds issued to raise money for green project. Green loans, you are taking loans in the name of investing in projects related to eco-friendly or sustainable projects. Now, who will provide you the green finance? Any government, bank, any private international institution, and any kind of private investors. If these are providing, they can provide you green finance. Now, we have international standard organization for green finance, very, very important. Very, very important. Now, these are what international standards they will provide a framework. So, a type of framework for different activities related to sustainable and green finance. Like ISO 32210, it is a framework for sustainable finance. It gives basic framework for bank and financial companies to follow your ESG practices. ESG is what? Environmental, social, and governance. 14007, it will tell you that how you can calculate your environmental cost. Environmental cost plus related to what benefit you are getting from that project. That is the cost. If you are investing in that project more and you are getting less on amount, that is not good for you. So this will tell you the environmental cost and benefit that will impact the environmental financial. 14,008 monetary valuation for environmental impact. Tell us how to give value money to environment damage or benefit. Like if any damage is there in environment, if you are protecting the forest or if you are putting more money on air pollution tactics, how to prevent air pollution. So these are monetary valuation. What valuation you are giving in terms of money. 14097 assessing and reporting investment related to climate change. Then building green finance, so 14,000 is important. It helps to identify and evaluate environmental impact of project, assets, and activities. Okay, from where you are taking the loan, what type of loan on what type of project you are investing. Okay, this applies to individuals, business, and different public organizations. So, what is the purpose of ISO 14,000? It will support your green finance. It will give the environmental criteria. It will help you to assess the all the risks which are related to your environment and also helps you in mitigating those risks. Reduces negative environmental effect, prevents greenwashing. Greenwashing is what is it is the tactic that makes your product appear more green. Okay. Eventually, it is not that much green, but that tactic will appear your products more green rather they are. Actually, they are. Now, see, these are IS. So, green bonds are what? Fixed income instrument. Now, green bonds are debt securities issued to finance environmentally. And this is important framework for green bond issuance established by International Capital Market Association for what? For increasing transparency and accountability, integrity of green bond market. Transparency and integrity. Now, green masala bond. What is green masala bond? Now, this is issued outside of India to raise money. To raise money for what? For your eco-friendly projects like renewable energy, clean water, etc. Why it is called masala? Because it is issued, it is in Indian rupees, not in dollars. Okay, but it is issued outside of India. And an Indian company issued green masala bond outside of the country, London. Let's take an example, London, to raise 100 crore. For what? For building a plant. So this is an example of green masala bond. So green, it is for environment and masala, it is in Indian rupees. But the money is raised outside. Now, greenwashing is what? It is the tactic making your products appear more green. Actually, they are. So what will happen? It will say it will be written on the labeling. The label is done in such way. The packaging is done in such way that it will appear more green. Like green color packaging will be there, or it is written that on top it is written 100% organic, okay, prevent the climate, combat climate change, or preventive measures are taken for environment. So all these tactics will be given on that product so that the customers they may get attract and they will buy that product. So that is greenwashing. So greenwashing, it we have to work on greenwashing so that it may reduce. Now, so SEBI guidelines are there in issue of green bonds in India. The SEBI term define the terms green or green debt securities in different manners. So what are the things that are included under green projects, under green securities? Those related to renewable sustainable energy, including wind, solar, bioenergy, clean transportation for public transportation, sustainable water management, climate change, energy efficiency, sustainable waste management, using sustainable forestry, afforestation, planting more and more trees, biodiversity conservation, and any other category that may be specified by SEBI. If all these are there, they are included under green securities. So for this, green loans, green bonds will be provided. Now, nationally determined contribution is what this it is submitted by India after Paris Agreement. See, and submitted in where in the Conference of Parties COP21, which was held in December 2015. Now, the main target for this COP meeting, Conference of Party 21, was that to keep the average temperature to below 2 degrees Celsius. Means so you can reduce your carbon emission. So the carbon emission should be kept at below 2 per degree Celsius. So these are all the 8 parameters of NDC. Sustainable lifestyle 1, 2, 3, 4, 5, 6, 7, 8. So all these 8 parameters are now. So COP21 and COP26, 21 was conducted in 2016. Now COP26 was held in year 2021. Now what was the main agenda for COP26? To keep the carbon intensity less than 45% by 2030, meet 50% of energy requirements by 2030. Non-fuel based energy, you have to keep it how much? 500 gigawatts by 2030. This also 30 and 70. This was conducted in the all this agenda was of COP26 in 2021. But now, okay, see, I have added the slide. Okay, just to go through once. Maybe this time they will ask you about the COP, the recent COP, the 29 COP. So it was held in November. It was held in the month of November. Now, key outcome of COP29, the 29th Conference of Parties under the United Nations Framework Convention on Climate Change. It was held in Baku, Azerbaijan. So Baku is a place and Azerbaijan is a country name. Now, what COP was conducted? COP29 was conducted. So COP29 was conducted in the year November 11, 2024 in the country Azerbaijan. And it is what? It is the venue is what? The place is Baku. Previous conference was held in COP 2018 in Dubai, and next conference will be held in COP 30 in Brazil. So I have added at least to go through one. And these are all the outcomes of COP 29, Conference of Party 29. Now, these are the 3 type of risks that are arised from climate change. The physical risk like flood, storm, drought, transition risk, moving to a more greener economy. Okay, moving from brown economy to a green economy. And liability risk, that is people or group might sue companies for causing pollution. If any company is causing pollution or any disturbances to another company, they can file the case, they can do the illegal proceedings further. So it might struggle to repay loan from bank. If company is fined heavily for polluting, it might struggle to repay loan from bank. That is legal risk. So PPL. And at least, okay, this go through one. Now, next we have completed sustainable, okay, financing, green and sustainable financing. Now, last chapter is what? That is your SPAC, special purpose acquisition companies. Now, before this, let me explain you one thing. See, suppose company A is there, okay? Now, A limited company is there. A limited company wants to acquire B limited company. Okay. Now, if A Limited wants to acquire B Limited company, then A Limited has to give full attention to B Limited company. B Limited is what the target company. Now, in this, the regular work of the A company will disturb. They have to pay more expenses, more costs will be there, negotiation will be there. Then who, if the company is the target company is acquired by A Limited, then who will become the new shareholders? What will be the shareholding? Then who will take the decisions on behalf of A Limited? So all these things will be there. Now for this thing, A Limited has made one new company. That new company is what? The C Limited company. Now this new company C Limited is known as SPAC, SPAC Special Purpose Acquisition Company. Now the work of this company is, what is the work of this company? To acquire company B. Company A has made the company C Limited and A will become the sponsor of C Limited. Now the work of C Limited is to acquire company B. And this company is specifically made for the acquisition purpose only. After the acquisition purpose takes over, this company will be wind up. This company will be get liquidated. That is known as de-SPAC. Now, after that, when A becomes the sponsor of this company, so how this company will arrange funds? Okay, from where this company will arrange funds to buy this B Limited? So so investors are there. Okay, the investors who will invest in A Limited, they will also invest in C Limited. Now, certain investors are there. These investors will invest in C Limited company. And how they will arrange money? Okay, they will arrange funds through IPO. These investors will arrange a fund for C Limited through IPO, that is initial public offering. Once they have arranged funds for C Limited, they will give the funds to C Limited. Now C Limited will acquire B Limited company and and the C Limited will hand over to A Limited company. So when this whole scenario gets over, this whole scenario will take approx 18 to 24 months. Okay, if in between 18 to 24 months, maximum 2 years, okay, maximum period is 2 years. Before that, if C Limited is not able to find the target company, does not able to acquire the target company, then the SPAC company has to return all its money to its shareholders, to its investors, not shareholders, to its investors. They have to return their money to investors. And in between this, one trust account is created. Trustees account are created. That trustee account are created just to see that the money which investors have invested in C Limited, their money should not be used in some other different purpose. Just to keep their money safe, the trustees are there and they will keep their money, the investors' money in the trust account. This is the whole scenario. Now let's do the reading. SPAC is publicly traded shell corporation specifically to raise capital through IPO for the purpose of acquiring another company. SPAC, they don't have their own operation. They are just created only for the purpose of acquisition. And the usually time is 18 to 20 months. If in this time period the acquisition is not completed, now it is required to return funds raised to its investors. Then the SPAC company, they have to return the funds to its investors. Now, what is the typical timeline? Formation of IPO phase, okay, searching for the company. So this will take approx 8 weeks. Now, after that, the SPAC, once SPAC is formed, now after that, the SPAC will search for the target company. See, over here now, here it is, see, already I have taken the example that we is the target company. But A wants to do the acquisition, but A does not know that who will be the target company. So C also have to do this work. C also have to search for the target company. They have to first analyze the market, the trend, okay, the pattern, what kind of business that company is having, that company will relate to our company or not. So all these things the C Limited will have to do. C Limited is what? The SPAC company. Clear? No. So they have to do the target search, then negotiations will be there, that seller and between the negotiation between the seller and buyer, several times meetings will be conducted, then they will reach on a particular agreement. So all this will be take up to 19 months. Now, Once all this work is done, okay, once the acquisition process is completed, now that company has to be de-SPAC, okay, closing of SPAC. So for this, the approval will be there, okay, shareholders approval will be there, the criteria will be set, then they have to fill the form, everything. So up to 5 months it will take. So they will wind up the SPAC and return the investment to shareholders. That is the, it will take approx 18 to 24 months for the completion of all these, the SPAC process. So again, SPAC process is for the parent companies. Now in this case, for parent companies for us, A Limited. If you will see, we have taken A Limited as parent company, B Limited the target company, and C Limited the SPAC. Now, A is what the parent company. Now, through special purpose acquisition company, they will buy what? They will purchase, they will acquire the target company. And who will provide funds to this SPAC company? Three investors. We have taken investor A, sorry, XYZ, na? X, Y, and Z. And how they will raise money? For the SPAC, they will raise money through IPO, initial public offering. So SPAC capital structure is what? To buy private company, they raises money by lending IPO. This money comes from big investors. That money will be kept under the trust account, so to keep the money safe. And when investors they put under the SPAC under C Limited, what they will get? They will get one share of SPAC stock, the value of that share, and one warrant also, which they can exercise later. So again, the right is given to exercise the warrant. No obligation is given to them. Now, and later on, what will happen? These can be separated when the whole process is completed into shares and warrant, which can be bought or sold in the stock market. Now, so in sponsors and sponsor is what? The A will become the sponsor of the C Limited. Okay, the previous, from that example, it can, we can see. Now, SPAC company is created. Who are the investors? The public investors. Now, under this trustee, the public money will be kept. The investors' amount will be kept safe, so that these SPAC will not misuse the money of those public investors. Now, so trust account is what? Special type of bank account where money is kept by someone. Okay, the trustee will keep the money for the benefit of the investors. That is the beneficiaries. And these trustees are responsible for managing their money. And in a SPAC, this account hold the money raising IPO. How money can be raised through IPO? If SPAC does not complete a deal, then they have to return money to investors. Now, this is important. In connection with the closure of IPO, by how IPO will get closed when the process is done, a sum equal to or greater than 100% of the proceedings IPO is used to finance trust account. Now, 95% of the amount will come from the general public, okay, through IPO, and 5% will, who will give? The sponsors will give. So roughly it is 95% of the funds from general public and 5 from sponsor. That is 100%. Now, how de-SPAC process is done? So when the SPAC process is completed, when company has acquired, when C Limited has acquired the B Limited and handed over to whom? And handed over to A Limited. Now, in this case, what will happen when all these activities is done? Then the company will be in the de-SPAC process. So it has 4 main steps. First, the approval is necessary. SPAC shareholders have to vote that yes, now we can de-SPAC this company. Okay, they have to do they also have to agree with the acquisition process. Founder approval also, the founders also have to approve with this process. Then after, when doing the de-SPAC, they have to fill the super AK form, AK disclosure form, that is now this acquisition process have been completed. Now we will de-SPAC to this company. And a redemption offer, that SPAC investors will get the choice. Who investors? The investors X, Y, Z. They will get the choice. Either they can stay in the newly merged, this SPAC will be de-SPAC and merged into the parent company. So either they can invest, they stay in that company, in that new merged company, or if they want, they can take their money back, they can redeem their shares. That is, buy back their money. Okay, so this is how the de-SPAC process is done. Now, shareholders' approval are mandatory. At the time of IPO, the shareholders, they are also known as what sponsor or any other holder. They will make the commitment only in the favor of de-SPAC transaction once the work has been completed. So therefore, at least how much approval is mandatory? 20% approval is mandatory. At least 20% of the outstanding shares of the SPAC will be committed to voting in support of de-SPAC. How much? 20%. So this is shareholders approval. Done. So refinancing, we have done all this now. So we have completed our chapter, that is module C and module D. So A and B, it was already uploaded yesterday, and today we have completed C and D. So with this full video, at least go through once the PDF will be uploaded. Go through the PDF once, and if you are having any doubt, you please do uh, please do ask in the comment section box. Okay. So I'll definitely answer your questions. So still we have today's night and tomorrow is your paper. So all the very best to all CIB candidates for who are appearing for the ABFM paper. Okay, so all the very best to you all. And please do let us know that how much marks you have obtained, you have scored in tomorrow's paper, and what were the question, what was the level of question, the pattern of question. Please do let us know in the comment section box. So let's meet tomorrow, okay, with the paper analysis, and the paper analysis will be at 11:30, I guess, 11 or 11:30. So let's meet tomorrow at that time. And once again, all the best to all CIB aspirants, those who are appearing for ABFM paper. Okay, so do your best and don't get panicked if any question if any question confuses you or any question if it is out of the box. So don't get confused at that time. Okay. So let's meet tomorrow, okay, at for the paper analysis, and please do let us know how much marks you have obtained and what was the level of question. Those who are watching the video right now. Okay, so PDF will be uploaded. Okay, don't worry about the PDF. It will be uploaded soon. Chal. Bye bye everyone. Good night. Once again, all the best. Okay, so bye bye everyone.